Very good morning. So, we'll continue our discussion with respect to gift provisions under income from other sources. Yesterday, I gave you 4-5 points to refer. I am sure you might have referred. So, today, first of all, we'll complete this gift provisions and then we'll move on to those small points. Gift provisions I have already discussed with you yesterday, partly saying that if you have received any gift from employer, then it is as taxable as per section 17 subsection 2 clause 8 in the chapter of income from salaries. If you receive anything from your supplier, customer or any other business associate, then that benefit or perquisite is taxable under the head profits and gains of business profession, irrespective of its value. Irrespective of its value. And the third point is, if you have received some gift or some benefit from any other person, means it is not taxable under income from salary, it is not even taxable under profits and gains of business or profession, then it can be made taxable under income from other sources, provided it does not fall into the list of exemption or list of exceptions. So we started our discussion from the list of exception or list of exemption. All those points which are falling here in this list, in these cases, gift is not taxable at all, irrespective of value. Whether the value is more than 50,000, less than 50,000, whatever it may be, it is not taxable at all. So we have discussed the first point, that is gift received from relative is not taxable. And I told you that the definition of relative is different. Section 40 capital A subsection 2 definition of relative was different. Here the definition of relative is different. We'll have you'll also learn the chapter of clubbing of income. There also definition of relative is different. So everywhere the definition of relative is different. So here we understood that gift received from a relative is not taxable. Relative in relation to individual means 7 persons, 7 points. Number 1, spouse of individual. Number 2, brother or sister of individual. Number 3, brother or sister of spouse of individual. Number 4, brother or sister of either of parents of individual. Number 5, lineal ascendant and lineal descendant of individual. Number 6, lineal ascendant and lineal descendant of spouse of individual. And the last one is point number 7, that is spouses of any of the persons referred to in point 2 to point 6. This was the definition of relative in relation to individual. Then we have HUF. In relation to HUF, all the members of HUF are considered as relative. I explained you one controversy yesterday, saying that for an karta of HUF is not a relative, but for HUF, karta is relative. So if HUF is receiving gift from karta, it is not taxable because we say that HUF has received gift from relative. But if karta is receiving gift from HUF, then in the list of individual, in case of individual, in the list of relatives, we don't have HUF. So for a karta, HUF will not be considered as relative. I also shared with you one Gujarat High Court judgment, saying that in that judgment, Gujarat High Court said that when you receive gift from when you receive gift from HUF, actually you are not receiving gift from HUF, you are receiving gift from group of individuals. And all those individuals in that group are individually relative for you. So whenever you receive gift from HUF, that will also be not taxable at all. This I had discussed with you. Then we moved on to point number B, wherein we discussed that gift on the occasion of marriage is not taxable. Gift on the occasion of marriage is not taxable, but gift on the occasion of marriage anniversary is taxable. Gift on the occasion of marriage is not taxable. I explained you the difference between the gift on the day of marriage and gift on the occasion of marriage. See, whether you receive gift on the day of marriage or before that or after that, it will not make any difference, because law uses the word gift on the occasion of marriage. So if the proximate reason behind the gift is marriage, in that case it will not become taxable. But definitely, yes, you can receive the gift because of marriage only up to the first anniversary. Once you have celebrated your first anniversary, thereafter everything is anniversary gift or other gifts. I also told you that gift received on the occasion of birthday, is taxable. Definitely, if it is taxable, we need to understand the set of rules as according to which it will become taxable. So friends, let's move on to the third point in this list. And the third point is property received by way of inheritance or will. Property received by way of inheritance and will. If someone dies, his property would definitely by default go to his legal heir. We have Hindu Succession Act in 1955. As per that, by default there are certain persons considered as legal heir. So if a person dies, his property by default will be given to the legal heir. And the legal heir, when he receives property, it is not taxable at all. It is not taxable at all. Say for example, person had already made the will saying that after my death, this property should be given to so and so persons. Death will gets executed only after the death of a person. Will is of no relevance if that person is alive. Will get executed only after the death of that person. Now, if that person has made a will saying that after my death, this property should be given to so and so person, then his will be executed after his death. The executor, maybe a lawyer, will execute this will. And the person who is receiving the property under this will, to them also, this is not taxable at all. So, if person has made the will and he has died, and he has written the name of beneficiaries in the will, then whatever property is received by beneficiary is not taxable at all. On the other hand, person has not made any will. He died without making the will. In that case, by default, the property will be transferred to legal heir. In that case, what is the treatment? Property received by legal heir is not taxable at all. So, irrespective of whether you receive the property by way of inheritance or under a will, it is not taxable at all. This is point number C. Now move on to point number D. Property received on contemplation of death of pair. Property received on contemplation of death of pair. Say for example, we have an individual Manoj. Manoj has not got married. He want to enjoy his bachelorship throughout his life. Now Manoj completed his chartered accountancy. He is earning decent amount of income. He is having a residential house property in which he is residing. Throughout his life, he has earned money. Now, he has fallen sick. He has fallen ill, severely ill. He has went to a doctor. Doctor has said that now you will stay alive for 10-15 days maximum. So, Manoj is not having wife, children, etc. No near ones or dear ones. But Manoj is having a friend, Ishwar. So, Manoj knows that within a period of 15 days, I am going to leave this world. I will be leaving this world. So, after my death, who should get my property? So, before his death itself, Manoj has called the lawyer. He has made the agreement, and as per that agreement, his property is given to Ishwar. This property is given to Ishwar even before the death of Manoj. Manoj is expecting a death. Because of that, he is transferring property to Ishwar. What do we say in this case? Property is received by Ishwar on contemplation. Contemplation means expectation of death of Manoj. This property received by Ishwar is not taxable at all. It is not taxable at all. Yes, is that very, very clear? Have you understood this? Okay. So this was point number E. Sorry, point number D. Now we move on to point number E. Point number E is anything received from local authority is not taxable. Anything received from local authority. See, income tax is not using the word gift. Income tax is not using the word gift. It uses the word anything received without consideration. Anything received without consideration. That is called as gift. So, if you receive anything without consideration from a local authority, that will also become taxable to you. That will also become taxable to you. Now you may wonder what benefit you are going to receive from a local authority. For example, there is a local authority hospital. There you got the free treatment. So definitely benefit is received by you. Yes. So that benefit will not be taxed. That benefit will not be taxed. Or maybe, for example, in a particular locality, there was a flood. There was a flood. There are a lot of people who are affected. To help them, the local body, the municipal corporation, local authority, they have compensated financially to those people who are affected. Say, for example, every household they have paid 10,000 rupees. So this is nothing but something received from local authority without any consideration. Means you are not giving anything to local authority. Local authority is giving you 10,000 rupees. In that case, this will not become taxable. Anything received from local authority is not taxable at all. Yes, have you understood this? Yes or no? Yes. So anything received from local authority is not taxable at all. Next, we move on to point number F. Any benefit received or any gift received from any fund, foundation, university, other educational institution, any benefit received from any fund, any foundation, any university, other educational institution received from hospital, medical institution registered in section 1023C will not be taxable. See, there are a lot of educational institutions who are not working for profits. They are working for providing education to the society. Their objective is philanthropic. Their objective is to help the society to get education. In that case, whatever benefit, if you receive free education from such an institution, nothing would become taxable. Besides that, there are a lot of medical institutions, hospitals, which are run by the charitable trust, non-profit organizations. There you get the medical treatment at a very reasonable cost, very low cost, or maybe free of cost also sometimes. So if you get any medical treatment free of cost from a medical institution or a hospital, in that case, nothing is going to be taxed to you. Because all these hospital, medical institutions, whose objective is not to earn profits, their incomes are already exempt in section 10 clause 23C, and whatever benefit they give to the society, those people who receive benefit, for them also it is not taxable. Is that very clear? Point number F. Point number G. Gift received from a trust registered under section 12A, 12AA. See, in CA final, there is a separate chapter called as Assessment of Trust. There is a separate chapter called as Assessment of Trust. In that chapter, you learn that there are different types of trust. For example, there is something called as public religious trust. There is something called as public religious trust, which is there to promote a particular religion, to ensure that there is harmony in the society. So, public religious trust will work for creating awareness about the religion, creating awareness that yes, there is a life after death, ensuring that people have ethics in the society. For all these objectives, we have public charitable trust. Sorry, public religious trust. And we have public charitable trust also. Public charitable trust will work like an NGO as well as NPO. So it is a non-government organization, not for profit organization. In fact, forget about profit. Its sole existence is for providing benefit to the society at large. So whatever benefits as an individual you receive from a public religious trust or a public charitable trust, they are not taxable at all. Say for example, on the occasion of some festival in a temple, they have arranged food twice in a day, and you had taken the prasadam there. That will not become taxable to you at all, because you have received some benefit from a public religious trust. Normally temples, all these things are managed by trust only. So if you receive any benefit from the public religious trust or a public charitable trust, and those religious and charitable trusts are registered in section 12A, 12AA, etc., then whatever benefit you receive is not taxable to you at all. Point number H. Gift received or benefit received by fund, foundation, university, other educational institution, hospital, medical institution referred to in section 1023C, subclause 4566A. Now, I am giving you 10-15 seconds time. You get me the difference between point number F and H. What is the difference between point number F and point number H? Yes? What is the difference between point number F and H? Section is also same. You need to read between the lines. Yes, very good. Deva has identified. Point number F and H, what is the difference? Now Vishnu has also identified. Point number F is you are receiving benefit from this fund, foundation, etc. Point number H is you are giving benefit to them. You are giving benefit to them. These are hospitals, medical institution, educational institution, etc. If you give benefit to them also it is not taxable. So it is both ways. If you receive benefit from them, not taxable to you. If you give benefit to them, not taxable to them also. Not taxable to them also. Point number H is over. Then we have point number I. All those transactions which are covered in the chapter of capital gain in section 47. Transactions which are not considered as transfer. Say for example, capital asset transferred by way of gift, will, inheritance, succession, devolution, partition with chief, under the scheme of amalgamation, under the scheme of demerger, capital asset transferred by holding company to wholly owned subsidiary, asset transferred by wholly owned subsidiary to the holding company. There are a lot of such transactions. conversion of debentures into bonds, conversion of debentures into shares, conversion of preference into equity shares. There are a lot of such transactions now covered by section 47. All such transactions, they are not considered as transfer. In the chapter of capital gain, they are not considered as transfer. And here, we are saying that in such transactions, if you have derived some benefit, that benefit will not become taxable to you right now. For example, there is an amalgamation. The value of shares of amalgamating company, market value of shares of amalgamating company is 500 rupees. And market value of shares of amalgamated company is 600 rupees. And you have received one share of amalgamated company against one share of amalgamating company. So don't you feel that you have returned the shares of fair market value of 500, whereas you have received the shares of fair market value of 600. There is a clear-cut benefit of 100 rupees to you. That will not become taxable. That will not become taxable. So all these transactions, section 47, clause A, clause 1, clause 4, 5, 6, 6A, 6AA, 7B, 7C, 6CA, 6CB, 6D and 7. All these transactions which are called by section 47. In these transactions, if you receive some benefit, nothing will become taxable to you. This is not that important. You may not remember this. Next is gift received from an individual by a private trust created solely for the benefit of relative of such individual. Do you understand private trust? Do you understand private trust? Say for example, we have Mr. Manoj. He is having property worth 400 crores. He is having property worth 400 crores. Now he knows that it is the time for him to leave this world. So before he dies, he created private trust. Manoj and family. Private trust. He has created this private trust. He has transferred the property worth 400 crores. He has appointed the trustee and the beneficiary. Trustee means those persons who will manage the property of the trust. Trustee means those persons who will manage the property of the trust. See, I cannot explain to the entire charitable institutions, etc. details in detail. It is part of CA final syllabus. I am just giving an example to understand what is a private trust. Say for example, Manoj has appointed me as a trustee of this trust. Ishwar is also trustee. So we both are trustees. And there is a list of beneficiary. Beneficiary means those people for whose benefit the trust is created. Those people for whom the income of the trust will be used, will be utilized. Those people will be called as beneficiary. So Manoj has written number 1. Mrs. Manoj, son 1, daughter-in-law 1, son 2, daughter-in-law 2. So these are 5 people. Manoj has created a private trust Why we call this as private trust? Because the beneficiaries which are given in the list, they are family members or specified individuals. List of those individuals is given. So these are all beneficiaries. Whatever income is generated from this 400 crores property, whatever income is generated, that income will be used for the benefit of these beneficiaries. So point is, when Manoj is transferring property worth 400 crores to this Manoj and Family Private Trust is receiving property without any consideration. This private trust is receiving property without any consideration. So here point number J says, nothing would be taxable to this private trust. Nothing would be taxable to this private trust. Have you understood this? Yes? Yes or no? Okay. So point number J is done. Point number K is a residuary point. This point was inserted to ensure that government can issue the notification at any point of time and extend this list. So it says gift received from such class of persons and subject to such conditions as may be prescribed. So government can issue the notification and put some more point in this list. That is the reason this point is inserted by law. This point is inserted in law. Because of this point, government will always have a right to issue the notification and extend the list. So here we have understood under what circumstances gift received is not taxable. Under what circumstances gift received is not taxable. If your gift is not covered by this list of exemptions or list of exceptions, then it can be taxed under the income from other sources. If at all it is taxable or not, that needs to be decided based on the flow chart which is given to you on the next page. This is the flow chart of entire gift provisions summarized in single page for you. Day before examination, quickly you can revise, maximum 5 minutes it would take. Now before we actually move on to this, let me remind you that yesterday I had told you that why the gift provisions were introduced in the Income Tax Act. Earlier there was a Gift Tax Act. When the gift tax law was prevalent, tax was levied in the hands of a person who was giving the gift. Tax was levied to the person who was giving the gift. That Gift Tax Act was scrapped. It was reintroduced. Once again it was scrapped. So finally it was scrapped in the year 2002. Thereafter, a lot of people started converting their black money into white. I explained to you yesterday saying that, say for example, I am having a white money of 10 crores and Manoj is having a black money of 10 crores. So black money means he is having cash. So I will give 10 crores to Manoj by check. So I am transferring my white money to Manoj. And Manoj will give me 11 crores in cash. So he is giving me 1 crore extra. That is the fees or commission which I have charged for converting his black money into white. So just by gifting my white money to someone else, that other person's black money can get converted into white. This was happening on a very large scale in India. That is the reason government was forced to come out with the law in the Income Tax Act for levying tax on gift. And in income tax law, tax is levied on gift in the hands of the person who is receiving the gift. It is the recipient who has to pay the tax. So keeping in mind this background, let us try to now move on to understand the gift provisions. Actually, it is not only a gift provision. Two things are covered here. Number one, what is covered is gift. I already told you income tax doesn't use the word gift. It uses the word anything received without consideration. It uses the word anything received without consideration. And second part is property acquired for inadequate consideration. Property acquired for inadequate consideration. So in this chapter, we have two things. Number one, property received without consideration. And number two, we have property received for inadequate consideration. First of all, let us try to understand. We'll try to understand both at the same time. So this is divided in two parts. Number one, gift received in cash, and number two, gift in kind. So broadly, this flowchart is divided in two parts. Number one, gift in cash, and number two, gift in kind. If you have received gift in cash, when we say gift in cash, by default it also includes gift received by check. It also includes gift check. So even if you receive money by transfer through the bank account, that will also be considered as gift in cash. So whatever gift you have received throughout the year, that gift is required to be aggregated. That gift is required to be aggregated, totaled up. If the aggregate amount of gift received during the financial year, during the previous year, is less than equal to 50,000, if it is less than equal to 50,000, it is not taxable, it is totally exempt from tax. Taxability arises only when the gift in cash aggregate amount is more than 50,000. Aggregate amount is more than 50,000. So on the right hand side we are writing, if the aggregate gift is more than 50, then it is totally taxable. Then it is totally taxable. Tell me, gift received on the occasion of marriage, aggregate is more than 50,000. Taxable or not taxable? Gift received on the occasion of marriage, aggregate gift is more than 50,000. Taxable, not taxable? Definitely not taxable. Definitely not taxable. Anything covered by this list is not taxable at all. Is not taxable at all. So you should not think about taxing it. If your gift or the benefit which you have received is not falling into the list of exemption, is not falling into the list of exception, then it will become taxable. That too, if the aggregate amount is less than equal to 50,000, no tax. If the aggregate amount is more than 50,000, yes, tax will be levied. Now the point is, say for example, you have received a cash gift. Aggregate amount is 60,000. Aggregate amount is 60,000. How much will be taxed? Entire 60 will be taxed, or only in excess of 50 will be taxed? That is 10,000. Yes? So the answer is entire amount will be taxed. Yes, all of them have given the correct answer. Entire amount will be taxed. That is the reason I have written here totally taxable. Totally taxable. If you want more clarification, you can write there entire amount is taxable. Entire amount is taxable. Yes. Shall I proceed? So gift received in cash less than equal to 50, no tax at all. More than 50, entire amount is taxable. Let's move on to the right hand side. Anything received other than cash. Anything received other than cash is divided in two parts. Number one, movable property. Number two, immovable property. Number one is movable property. Number two is immovable property. What all things are covered by movable property? What all things are covered by the term property is written here. Property means following capital assets of the SSC. Property means following capital assets of the SSC. Number one, immobile property being land, building or both. Number two, shares and securities. Number three, jewelry. Number four, archaeological collection, drawing, painting, sculpture, work of art, bullion. Can you recollect this list? Have you studied this list earlier? Yes or no? Where did you study this list earlier? In the chapter of capital gain, in that personal effect, in that exception, specified movable assets. They are considered as capital asset. So that is the list copied here. And we are saying that, see, out of this list, only the first one is movable property. Sorry. Out of this list, only the first one is immovable property, rest all are movable properties. Bullion means what? Dikshit is asking me, bullion means what? Dikshit, bullion means gold, silver, platinum, etc. in a unfinished form. Basically gold biscuit or gold coin. Bullion means gold biscuit or gold coin. You can purchase gold now, 1 kg of gold. 1 kg of gold biscuit if you buy, it is as small as 2 Parle-G biscuits kept one besides the another. So that gold biscuit, gold bar, we can call it as gold bar. That gold bar is called as bullion. Silver bars are called as bullion. Yes? Now listen to me very carefully. I'll ask you some questions. You should think and answer. Say for example, Manoj is celebrating his marriage anniversary. So on the occasion of marriage anniversary, if he is receiving some gifts, they are taxable or not taxable? Taxable. So listen to me very carefully. Say for example, Manoj is celebrating his marriage anniversary. I have gifted him, or maybe Manoj is celebrating housewarming ceremony. He has purchased a new house, so he has kept a housewarming ceremony and he has invited me. So when I went for that ceremony, I took a lot of gifts for Manoj. And just after getting married, just within a month, he bought a new house. So he was recently married also, and I also attended his marriage. Thereafter, he bought one house and he invited everyone to attend the housewarming ceremony. In that 1 month's time, I came to know that Manoj's wife do not know how to cook. So what I did, taking the advantage of this situation, I decided to gift something to Manoj, saying that this can be acting as an entire package for her wife to learn cooking. So what I have done, I have purchased 2 books. There is an individual called as Sanjeev Kapoor. Are you aware about him? Sanjeev Kapoor. He is India's most popular chef. He is India's most popular chef. There are a lot of television programs also which he is doing. So I have purchased Sanjeev Kapoor's book. He has written a book, how to make different things. So breakfast, lunch, dinner, special items. So in breakfast he says how to make upma, best quality upma, how to make hygienic idlis. Idlis are by default hygienic. But how to make soft idlis. He has written the book. So I bought that book, volume 1, volume 2. It costed me 4,000 rupees. Besides that, I bought dinner set. Plate, bowl, spoons, glass. I bought a dinner set. I bought a idli making cooker. I also bought 4-5 kgs of rice. 1.5-2 kg of dal. Then I have bought sambar powder. All these things I have packed. And the total value of all these things is around say 60,000 rupees. All these things I am gifting to Manoj. I have gifted mixer, grinder, juicer, all these household utensils. Stove, gas, everything. I am gifting him. Aggregate value is more than 50,000. Will it be taxed or it will not be taxed? Yes. So Parvez says taxable, Deva says taxable, Sarvana says taxable, Rizwan says not taxable. So the correct answer is it is not taxable at all. It is not taxable. Why? Because whenever you receive movable property as gift, it is taxable only if it is covered by the definition of this property. You look at the definition of property. Can you see the book? Can you see idli cooker? Can you see dinner set, mixer, grinder, rice, dal, sambar powder? No. So all these things are not taxable. Examiner will intentionally confuse you, saying that Mr. X has received a gift, Mercedes car costing 30 lakhs. Taxable, not taxable. The moment you see more than 50,000, you say 30 lakh rupees, it should be taxed. Answer is it is not taxable. So if you receive mobile as gift, laptop as gift, computer as gift, car as gift, or you receive clothes as gift, you received a bag as gift, all these things are not taxable. You received furniture as gift, television, refrigerator, washing machine, sofa set, AC, all these things you have received as gift, they are not taxable at all. Because those things are not covered by the definition of term property. Only those things which are covered by the definition of term property can be taxed. I do not know, you might not be knowing, you might not be watching the Bollywood news, or you might not be reading the newspapers wherein you have a Bollywood news. In Bollywood, the actor and actresses would generally gift car to each other. Why they are gifting car to each other? Because car is not taxable, because it is not covered by definition of term property. That is the reason. The chartered accountants are guiding them, saying that if you give money as gift to the other person, it will become taxable. But if you give him car, it is not taxable. So please be very careful. Car may be valuing 10 lakh, 15 lakhs, but it is not taxable at all. Only those things which are covered by this list is taxable. Other than that, nothing is taxable. So movable property I am dividing it in two parts. Covered by the definition of term property, not covered by the definition of term property. If it is not covered by the definition of term property, then it is not taxable. If it is not covered by the definition of term property, then it is not taxable. I already told you, mobile, laptop, car, all household utensils, everything which is there in house, movable, except jewelry, gold, etc. Those things are not taxable at all because they are not covered by the definition of term property. Yes, have you understood this point very clearly? Yes or no? Yes? Are you getting my voice? Yes. Okay. Sarvana says, sir, section 17 to clause 8, same thing is applicable? No, not applicable. I'll take an example, don't worry about it. I'll take one common example to make you understand the gift provisions everywhere in the Income Tax Act. First of all, let me complete this. So, taxability will arise only if it is received, the gift received, movable property received is covered by the definition term property. So, now I am dividing this in two parts. Received without consideration. When we say received without consideration, it is gift. You take the aggregate. If aggregate value is less than or equal to 50, no tax. If aggregate value is more than 50, totally taxable. Totally taxable. If you want to write here, you can write. What you will write? Entire amount is taxable. Entire amount is taxable. Is that clear? Now let me ask you a question. Listen to me very carefully. Say for example, Manoj is celebrating his marriage anniversary. He has received gift. You all were invited. Say for example, he has invited 100 friends. And he has invited me also. Manoj has received in that gift cover, envelope. He has received 300 rupees from each of his friends. All the friends collided with each other and they decided that we all should give same amount, 300 rupees. So, Manoj has received 300 rupees from 100 different persons on the occasion of marriage anniversary. So, what is the aggregate amount of cash received by him? 300 into 100, 30,000. 30,000. And I have gifted him a gold bar, a small gold bar. I have gifted him a gold bar worth 30,000. So he has received a cash gift, cash 30,000, gold bar 30,000, aggregate 60,000. Taxable, not taxable. Yes? Taxable or not taxable? Have you understood the question? On the occasion of marriage anniversary, he has received a cash gift aggregating 30,000, gold bar value 30,000, total 60,000. It is taxable or not taxable? Every one of you should answer. Huh? So correct answer is it is not taxable. It is not taxable. Why it is not taxable? Because that 50,000 is a separate limit for gift in cash and 50,000 is a separate limit for gift in kind. You should not take the total of cash and kind. Aggregate of cash gift should be kept separately. Aggregate of movable property gift should be kept separately. So, we should not do the aggregate of cash and kind. Cash should be aggregated, kind should be aggregated. Individually, it should be seen whether it is more than 50 or not. Now, listen to me very carefully. Say, for example, I am having white money. I am having white money. Manoj is having black money. Black money means lying in his home in cash. Below the bed, he has kept very big bag full of cash. Now Manoj wants to convert this black money into white. If I give him cash gift, if I transfer say 1 crore, if I transfer 1 crore through bank account to Manoj, will it be taxed to Manoj? Yes. If I transfer 1 crore to Manoj through bank account, will it be taxed to him? Definitely yes. Because now cash gift aggregating more than 50,000, they are fully taxable. So people came out with some different idea. People came out with some different idea to convert their black money into white. I am having white money, so I am going to the bullion market. I am going to bullion market. Bullion market means market from where I can buy gold and silver bars. Bullion market, I have gone to a vendor and I have purchased a gold bar. Gold bar, 2 kgs. And I have paid him 1 crore. White money. I paid him 1 crore white money and I bought 2 kgs of gold bar. Now this gold bar, if I gift to Manoj, value is 1 crore. If I give this gold bar as a gift to Manoj, will it be taxed to him or will it not be taxed to him? Yes. It will be taxed. It will be taxed. Why? It is clearly falling in the list of property. Jewelry, archaeological collection, drawing, painting, sculpture, work of art, bullion. It is falling in the list of property, so it will be taxed. But instead, what we have done, I have not given this free of cost to Manoj. This gold bar is sold to Manoj for 10 lakhs. Gold bar is sold to Manoj for 10 lakhs. And Manoj is transferring me 10 lakhs white money. Manoj is transferring me 10 lakhs white money. And I am selling my gold bar worth 1 crore only at 10 lakh to Manoj. Can someone stop me from doing this? Can income tax department say, oh, gold bar worth 1 crore, why did you sell for 10 lakhs? Who are you to ask me the question? It was my property. I can sell it for 1 rupee also. Who are you to ask the question? Yes, but if this would have been a immobile property, then you have section 50C, which says that if stamp duty value is more than 110% of agreement value, then stamp duty value will be considered as full value of consideration. Or if you have sold the unlisted shares and the sale consideration is less than the fair market value, then fair market value will be considered as full value of consideration for the purpose of computation of capital gain as per section 50CA. But we don't have any such section when I sell the gold bar at a discounted price. There is no section to catch me. So as a result of this transaction, what will happen? I will calculate capital gain. And my hands, while calculating capital gain, what will be full value of consideration? 10 lakhs. What will be cost of acquisition? 1 crore. What is the short-term capital loss? 90 lakhs. 90 lakhs. Do you believe I am fool to sell my gold worth 1 crore only at 10 lakh rupees? Definitely not. Manoj is paying me white money 10 lakhs and he will also give me black money. How much? 1 crore. 1 crore black money. So I am giving my gold bar worth 1 crore only at 10 lakhs to Manoj. And Manoj is transferring me black money of 1 crore and white money of 10 lakhs. Now what Manoj will do now? Manoj will go to this bullion market. He will sell the gold bar. There he would receive which money? White money. White money 1 crore. Now the point is, what Manoj will do now? Manoj will have to calculate capital gain because he has sold the gold bar at 1 crore. So he will take full value of consideration 1 crore. Cost of acquisition 10 lakhs. Capital gain 90 lakhs. But Manoj is already having some capital loss to set off. Manoj is already having some capital loss to set off. So he will set off that capital gain and he will not pay any tax. What is the consequence of this entire arrangement? Manoj's black money has got converted into white money without payment of tax. Such kind of arrangements were done by the people to evade the tax, avoid the tax. Therefore, government was forced to come out with additional provisions in the Income Tax Act. So what provisions government came out with? Now government is saying that if you have not received anything free of cost, you actually purchased it by paying money for it. But the consideration paid by you is inadequate. Gold bar worth 1 crore, you bought it only for 10 lakhs? Are you so much super intelligent that you can fool anyone? No, we don't believe this story. You might have paid that person black money. That is the implied assumption. So, government says, if you have acquired any property for inadequate consideration, you ascertain the amount of inadequacy. Inadequacy equals to fair market value minus amount paid. This provision is made from the point of view of Manoj because his black money is getting converted into white money. So, person whose black money gets converted into white money, tax will be levied in his hands. So, Manoj has acquired gold bar worth 1 crore, market price is 1 crore, but only at 10 lakhs. What is the inadequate consideration? What is the inadequacy? 90 lakhs. This inadequacy is, if it is less than equal to 50, no tax. If it is more than 50, fully taxable. Whatever transactions Manoj has entered throughout the financial year for inadequate consideration, all those transactions individually inadequacy will be ascertained. For each and every transaction, Fair market value and consideration paid will be compared. Difference will be found out. You will be having inadequacy amount of each and every transaction. Then you take up the aggregate of that inadequacy. If that aggregate inadequacy is less than equal to 50, no tax. If the aggregate inadequacy is more than 50, taxable. And let me tell you, this limit of 50,000, everywhere limit of 50,000 is there, and those are independent limit, they are separate limits. Don't merge two limits of 50,000. Have you understood this? Yes? Yes or no? Now let me give you one example. Let me give you one example. In Chennai, there was a Kalyan Jewellers. Do you know Kalyan Jewellers? Do you know Kalyan Jewellers? Yes. Say for example, see whenever these big giant companies who are into jewelry business, they set up any branch or they start the new branch, they would generally give a full page ad in the newspaper. Front page, they will give a full page ad. But this time, Kalyan Jeweler has set up a new branch in Chennai. Today is the inauguration ceremony of this Kalyan Jeweler branch. And they have decided to do a marketing gimmick this time. So what they have done, they have not given a very entire full page ad on the front page of the newspaper. Instead of that, they have given a very small ad. That too, it doesn't appear like an ad. In between that pages, maybe page number 10 or 12, somewhere a small thing is appearing. It is written that today is the opening ceremony of Kalyan Jewellers Chennai branch, Nugampakam. All those customers who get into the branch from morning 9 a.m. to 9:15 a.m. can buy the gold jewelry at 50% discount. Conditions apply. Now, Deva madam was sitting ideal at home. So, she got up early morning. She has taken bath. Now, she has decided to read the newspaper. And while she was reading newspaper, she came across this advertisement, which was actually not appearing like an advertisement. It said that today is the opening ceremony of Kalyan Jewellers Chennai branch, Nugampakam. If the customer gets into the branch from 9 a.m. to 9:15 a.m., he can buy the gold jewelry at flat 50% discount. So she has shown this ad to her mother. And her mother says that, no, you have not seen the world. These all are marketing gimmicks. They will fool you. No one is going to give you jewelry at 50% discount. In which world you are living? Haven't you seen such kind of advertisements earlier? So, out of excitement, still, after listening a lot of things from her mother also, out of excitement, she has called up the number which was given there. And she spoke to the other person who was on other line, saying that today, have you given this advertisement? So you are saying that there is a flat 50% discount. So what you will do? You will increase the MRP of the jewelry from 1 lakh to 2 lakh, and then you will say flat 50% discount. You are here to fool us. So from the other side, the voice came saying that, madam, this is an offer only for 15 days or 15 minutes. And we are not fooling you. We are actually going to give gold jewelry at 50% discount. So now she is asking, no, but what is that conditions apply? So the other person said, condition is you cannot buy jewelry of more than 2 lakhs. So otherwise you will come to our shop and say that give everything to me at flat 50% discount. So you will bring 10 crores and you will take away everything. No, that cannot be done. You can purchase a jewelry of maximum 2 lakhs. So now she knows that yes, this is real, but she is unable to convince her mother. So she has decided to at least go and see whether this is real or they are fooling people. So she went to that shop. Sharp 9:05 she has reached. Inside the shop there are only 3 customers. Now they have closed the gates. Now they have asked those customers who reached there to select the jewelry. Now Deva has called her mother saying that actually they are selling jewelry worth 2 jewelry at 50% discount, but you can purchase only worth 2 lakhs. There are only 3 customers. The other customers are waiting outside. News channels are also waiting outside. The moment I come out of the shop, they will be taking my interview. So please get me 1 lakh rupees. So now her mother is also excited. Now she is carrying 1 lakh rupees and Deva has bought jewelry worth 2 lakhs at 1 lakh. The moment she comes out of the shop, the news channels are taking the interview. How you are feeling? You have bought jewelry of 2 lakhs only at 1 lakh rupees. So you have got a benefit of 1 lakh. So all news channels are running behind them. Now the point is, she has purchased gold jewelry worth 2 lakhs only at 1 lakh. So what is the inadequate consideration? Yes, gold jewelry worth 2 lakhs bought at 1 lakh. Inadequate consideration is 1 lakh rupees. Will this become taxable? Will this become taxable? Taxable or not taxable? So answer is, it is not taxable. It is not taxable. Why so? Because do you believe that here Deva has converted her black money into white? No, not at all. It was a genuine transaction. Therefore, here government has inserted an exception. If something is acquired from a registered dealer means who is registered under the GST. If something is acquired from a registered dealer for inadequate consideration, then nothing is taxable. Then nothing is taxable. So she has acquired something from a registered dealer for inadequate consideration. So nothing is taxable. So when you acquire something from a registered dealer for inadequate consideration, nothing is taxable. Have you understood this? Yes or no? Okay, let me give you one example. Let me ask you one question. Listen to me carefully. Say for example, Manoj is in dire need of money. In this COVID, he has lost his job. He was in dire need of money. So from where to arrange funds, he do not know. So Manoj's wife said to Manoj, do one thing, you sell this gold jewelry. You sell this gold jewelry. In future, when we earn money, we will once again purchase it. So Manoj has taken this gold jewelry. He has gone to the jewelry shop and he has sold the jewelry. That jewelry shop owner has purchased jewelry worth 6 lakhs at 5 lakhs. That jewelry shop owner has purchased jewelry worth 6 lakhs at 5 lakhs. So he has acquired jewelry for inadequate consideration. Inadequacy is 1 lakh rupees. Will it be taxed in his hands? Yes. Will it be taxed in his hands? Yes or no? See, every one of you should answer. So that if you do mistake here, you will not do the same mistake in the examination. Jewelry shop owner has acquired jewelry worth 6 lakhs at 5 lakhs acquired for inadequate consideration. Deva says not taxable. Why not taxable? Deva madam, why not taxable? Akash, Parvesh, all of them are saying not taxable. Why not taxable? It does not fall into this. No. If you are referring to this and saying that it is not taxable, then it is not the correct thing. Why? In this point, Your situation will be covered by this point if you are acquiring something from a registered dealer. If you are buying from a registered dealer, this situation is covered by this point. But the example which I gave you, in that you are not buying something from the registered dealer, that registered dealer is buying something from you. This point says the seller should be registered. Are you understanding? No, while buying gold you might have paid tax, that is different. While buying gold you might have paid tax, Akash, but that is different. Right now your gold worth 6 lakhs, you are selling to a jewelry shop owner at 5 lakhs. You need to think from the point of view of jewelry shop owner. He has purchased your gold worth 6 lakhs for 5 lakhs. Taxable to him or not taxable to him? Answer is taxable to him, but under the head PGBP, not under the head IFRS. Why? Because here it says property means following capital assets. That jewelry shop owner, for him, that jewelry is not a capital asset. Under that IFRS, taxability would arise only if these movable properties are capital asset for you. So that jewelry shop owner has purchased the jewelry at 5 lakhs. So he will write in his profit and loss account, to purchases 5 lakhs. Now he has done the polishing of that. He has incurred some expenses on polishing. Now he has sold that jewelry for 6.5 lakhs. So he will write buy sales 6.5 lakhs. Automatically differential amount will become taxable to him under that PGBP. No tax under the IFRS. This will not be covered by this point. Acquired from a registered dealer means registered dealer is a seller. Your example which I gave you, in this registered dealer was a buyer. Have you understood this very clearly? Yes or no? So, very important discussion we are having. See, such kind of points are intentionally created and asked in the examination. Even after giving the wrong answer, student will never realize he has given the wrong answer. He will always believe that my answers were correct. But on the day of result, he would get very less marks, or maybe he will fail. And he will also not come to know why he has failed. That is what is the problem of this professional examination. So, left hand side is entirely over. So, you have to refer this flow chart. Simply you have to refer this flow chart. That's all. Now, let's move on to right hand side. Immovable property. Immovable property received without consideration. Received without consideration means received as gift. Say for example, Manoj is celebrating his marriage anniversary. He has invited all of us, and you all are discussing what should we give as a gift to Manoj, and you all have decided that everyone should contribute some amount. Rizwan, not taxable. Dealer has acquired something from Manoj, not taxable to dealer under the IFOS, because for a dealer it is not a capital asset, it is stock in trade. Rizwan, for a dealer that jewelry is what? Stock in trade, na? Okay, now listen to me. Manoj was celebrating his marriage anniversary. You all were discussing as to what gift you should give to him. And I said that how much amount you all are ready to contribute. You said we are all ready to contribute 1200, 1300 rupees. I said, do one thing. You all contribute 1,500. I will select the gift and we all should give same gift to him, same gift. And it will be a surprise for him also and surprise for you also. You just give me 1,500 rupees contribution. I will pack the gift in the envelope and I give that envelope to you. We all will go in that marriage anniversary celebration. When we go on a stage to congratulate Manoj, every one of you should give that envelope. What is there in the envelope? You also do not know, Manoj also do not know. It is a surprise for both of you. So you all agreed and you all paid me 1,500 rupees. What I have done now? I have purchased a plot of land, 1,000 square feet plot of land. And that plot of land is registered in name of Manoj. And the registered document, plus separate plot of land, not only one plot of land, plus separate plot of land. Plot number 1, plot number 2, plot number 3, plot number 4. Say for example, there are 51 individuals. There are 51 individuals. So 51 different plots are purchased. Every plot is of 500 square feet, one besides the another. And registry is done. That plot is registered in the name of Manoj. That registration document I have put it in that envelope. And those envelopes I have given it to you. Same size, the same color, same weight, everything is same. Now every one of you are having the envelope. When you go on a stage, congratulate Manoj for his marriage anniversary and gift this envelope to him. So he has received the first envelope. So he is very happy seeing the size of the envelope. So he has kept that envelope and he has said thank you very much. The next person comes, he is giving the same envelope, same size, same color, everything same. So Manoj is wondering whether he has picked up my gift only and gifting back to me. So just he saw that and he realized no, his earlier gift is lying there only. So coincidentally he has bought the gift in the same envelope. So he has taken, once again he has thanked that person. Next person comes on a stage, same envelope. Manoj says, how this can be coincidence? There is something fishy here. Every individual has given the same envelope. He has now accumulated 51 envelopes. Now he is very much excited to see what is there in the envelope. The program is over. They have reached home. So Manoj has opened all the envelopes. And in each and every envelope, he has found that it is a registered document in his name for 500 square feet plot of land. All this plot of land are one beside another. So he just decided to find out the location where this plot of land is actually situated. So he found out in a Google map that this is situated somewhere in the jungle where no one would stay, no facilities, nothing. This entirely jungle. The price there for 1 square feet is only 2 rupees. That too no one is ready to buy. It was a very bigger shock for him. But we have gifted him plot of land. Now every plot of land stamp duty is only 1,000 rupees. Every plot of land stamp duty is only 1,000 rupees. And he has received how many plots? How many such plots? 51 plots. 51 plots. Stamp duty of every plot is 1,000 rupees. So the aggregate value of stamp duty is 51,000. Taxable to him or not taxable to him? Yes? Taxable to him or not taxable? Yes, please answer. Have you understood the question? Manoj has received plot of land as gift. 51 different plot of land. Aggregate value of all plot of land is 51,000. Answer is, it is not taxable. It is not taxable. Why it is not taxable? Because here in case of immovable property, we should not take aggregate amount. Parvez, it was not marriage, it was marriage anniversary. It was not marriage, it was marriage anniversary. Anything which you received on the occasion of marriage anniversary is definitely taxable. But in case of immovable property, you are not supposed to take up the aggregate. In case of cash, movable property received as gift, movable property received for acquired for inadequate consideration, everywhere I have written what? Aggregate. See, this word is underlined here. It's very important. Everywhere we have written aggregate. So everywhere on the left hand side in the flow chart we have written aggregate, but if you look at the right hand side, here I have written stamp duty value of each property. Stamp duty value of each property. So here you are not supposed to take aggregate. You have to look at the stamp duty value of each property separately. Each property, individual stamp duty value you have to see. See, first of all, in case of movable property, you have to see fair market value. In case of immovable property, you have to see stamp duty value. In case of movable property, you should take the aggregate of the fair market value, whereas in case of immovable property, you should not take aggregate. You should not take aggregate. Yes. So here, if the stamp duty value of each property is less than or equal to 50, no tax. If the stamp duty value of each property is more than 50, it is totally taxable. Yes. Now we move on to the extreme right hand side. That is last part of this discussion. Yes, okay. Somehow my Zoom got disconnected. So have you understood this left hand side? Immobile property received without consideration. You have to look at the stamp duty value of each property. Don't do aggregate. Look at the stamp duty value of each property. Now let's move on to the right hand side. Very important. Here you can recollect the provisions of capital gain chapter section 50C. You can recollect the provisions of chapter capital gains section 50C. If stamp duty value is more than 110% agreement value, stamp duty value will be considered as full value of consideration. That section 50C was from the point of view of seller of the property. Here we have the provisions in the chapter of income from other sources, and these provisions are from the point of view of buyer of the property. Similar provisions, but from the point of view of buyer. Here we are saying inadequate property acquired for immobile property acquired for inadequate consideration. There is a immobile property which you have acquired for inadequate consideration. Left hand side, it was immobile property acquired without consideration, free of cost gift. Here you have acquired for inadequate consideration. So you have to find out inadequacy. Inadequacy equals to stamp duty value minus amount paid. In case of movable property, for ascertaining inadequacy, we compare with the fair market value. For immobile property, we compare with the stamp duty value. So you look at the stamp duty value, from that you deduct the amount paid, the difference is inadequacy. Now, once you have ascertained the inadequacy, then you refer to this flow chart and give the answer. What it says, if inadequacy of each property, don't take the aggregate. The aggregate is required to be taken only in cash and movable property. Immovable property, don't take the aggregate. look at the value of each property individually, separately, independently. If inadequacy of each property is less than equal to higher of 50,000 or 10% of consideration, then no tax. If inadequacy of each property is greater than higher of 50,000 or 10% of consideration, then inadequacy is fully taxable. See, you might not have understood this. I am taking an example to make you understand. Listen to me very carefully. Example. Immobile property acquired for inadequate consideration. Listen to me very carefully. Say for example, the agreement value is 10 lakhs. Agreement value is 10 lakhs. Stamp duty value is 10 lakhs 70,000. You can write this example if you want, because it is very important. You can write somewhere in your notebook or somewhere in the textbook itself. And you can say, you can write this as example number 1. Immobile property acquired for inadequate consideration. I have given you the numbers. Agreement value is 1 lakh. Stamp duty value is 10 lakh 70. Now you first of all ascertain the inadequacy. What is inadequacy? Inadequacy equals to stamp duty value minus amount paid. Is nothing but 70,000. That is 10 lakh 70 minus 10 lakh. Now listen to me. No, don't do calculation. You just listen to me. Just try to understand what I am trying to explain you. Don't apply your mind right now. I am simplifying the things for you. Once you have calculated this, now in mathematics you say na, left hand side, right hand side. LHS, RHS. LHS you write inadequacy. What is inadequacy? 70,000. 70,000. RHS, you write higher of point A and point B. What is point A? 10% of consideration. I am writing the same thing, just I am creating some space for me. LHS, RHS. RHS is nothing but higher of point A and B. Point B is 50,000. Point is 10% of consideration. Now, can you tell me what is the amount of consideration? 10 lakhs. Amount of consideration is 10 lakhs. What is 10% of that? 10% of that is 1 lakh. So 1 lakh or 50,000, whichever is higher. 1 lakh or 50,000, whichever is higher. So I have selected what is higher? 1 lakh is higher. So I need to select 1 lakh. Now, don't you feel that my LHS is less than RHS? Yes. My inadequacy is 70,000, which is less than 1 lakh. LHS is less than RHS. In that case, amount taxable is 0. Nothing is taxable here. Have you understood this? Look at the provision. Inadequacy of which property? First of all, you ascertain inadequacy. Compare this inadequacy is your LHS. Inadequacy is your LHS. Compare that with 50,000 or 10% of consideration. In our example, 10% of consideration is 1 lakh. 1 lakh or 50,000, you select whichever is higher. That will become your RHS. So in our example, our RHS is 1 lakh. LHS is 70,000. You want to feel your LHS is less than equal to RHS? Yes. What is taxable? Nothing is taxable. Have you understood this? Yes or no? See what you can do. You can take the photograph if you want. Shall I proceed? Have you copied this? Because I am not going to write this once again. I will make the changes here only. Dikshit, wait for some time. I will move on to note 2, don't worry about that. Shall I change the example? Yes. So I am changing only one number. See what I have changed? I am making this as example number 2. Agreement value is same 10 lakhs. Stamp duty value is 11 lakh 70. In the earlier example, we had taken 10 lakh 70. Now I am making this as 11 lakh 70. So what is the inadequacy in this case? 1 lakh 70. So my LHS is 1 lakh 70. What is RHS? 10% of consideration, 1 lakh or 50,000, whichever is higher, 1 lakh is higher. My LHS is less or LHS is more? Yes. LHS is more than RHS. Consequence. LHS is taxable. What is the consequence? LHS is taxable. So this 170 will be taxed. This is about example number 2. Have you understood this? Shall I proceed? So this entire provisions with respect to gift and property acquired for inadequate consideration are over. Here Dikshit was asking me, sir, what is that note number 2? Note number 2 is not relevant for you. I am just telling that earlier last year here it was instead of 10% it was 5%. Here it was 5%. This is increased from 5% to 10% with effect from assessment year 21-22. Yes. So we have completed this. Which all points were given to you as homework? Let us now discuss those. Point number 3. 3, 4, 5, 7, 8. So I am moving on to point number 3. Employees' contribution to staff welfare scheme. Who has contributed to staff welfare scheme? Employee. Staff welfare scheme means provident fund, pension fund, superannuation fund, gratuity fund, etc. These are staff welfare schemes. Employee's contribution, employee is not going to give from his own pocket. Employee will not give his contribution from his own pocket. His contribution will be deducted by employer from salary paid to him. So when the employer pays salary to employee, from that he would deduct the contribution. Here we need to understand what is the tax treatment. We need to understand what is the tax treatment for employees' contribution. What is the tax treatment in the hands of employee and what is the tax treatment in the hands of employer? I am having a detailed discussion. I am not only focusing on income from other sources, I am focusing on all the aspects in all the chapters taken together. So you have to listen to me very carefully. We are on a very important point here. So what I am discussing with you is tax treatment of employees' contribution. Tax treatment of employees' contribution from the point of view of employee as well as from the point of view of employer. From the point of view of employee as well as from the point of view of employer. First of all, let us discuss from the point of view of employee. Employee's contribution is what for employee? Employee's contribution is an investment for the employee. Employee's contribution is an investment for the employee. For doing this investment, government wants to offer an incentive to the person. So government says you can claim deduction for this in section 80C. Provided the fund is statutory provident fund, recognized provident fund, approved superannuation fund, approved pension fund, etc. Basically, fund should be approved. This we are going to discuss in the next chapter, that is deduction from gross total income. But I am just ensuring that you should have an overall understanding. That is the reason I am discussing everything in a cumulative manner here. So all the points which are there in different parts of the income tax act, different sections, everything is accumulated here. So we need to understand what is the tax treatment of employees' contribution. Employees' contribution is an investment for employee. For this investment, government is offering incentive. He can claim deduction in section 80C. Now right hand side. What is employees' contribution for employer? Employees' contribution is a liability for the employer. Is a liability for the employer. But I have already explained you this in the chapter of PGBP also, saying that employees' contribution is a liability for employer. That is correct. But Income Tax Act says that it should be considered as an income of employer as per section 2 clause 24 subclause 10. It should be considered as an income of employer. So section 2 clause 24 subclause 10 is nothing but definition of income. Actually this is not income, this is the liability, but government wants you to consider this as income. So this will be added to employer's income. This will be added to employer's income. Thereafter employer can claim deduction. Thereafter deduction will be allowed. So first of all it will be added to employer's PGVP income. Thereafter it will be deducted from employer's PGVP income. You may think, what is the point of adding and then deducting? So I am telling you that it is always added, but deduction will be given only if this amount is deposited by the employer in the retirement fund account within some due date. There is some due date for depositing this money in the employee's retirement fund account. If you deposit money in that account, if the employer deposits that employee's contribution in that retirement fund account within the due date, then deduction will be allowed. If he is depositing after the due date, deduction will not be allowed. So here we are saying, thereafter employer can claim deduction if he deposits such amount in employee's retirement fund up to the due date. Up to the due date. Now look at the left hand side here. For example, listen to me very carefully. For example, Inside Commerce Studies has hired 25 people. For example, Inside Commerce Studies, they have started with multiple branches and they have hired 25 persons. So is it mandatory for them to maintain provident fund? Yes, it is mandatory for them to maintain provident fund. Whatever activities Inside Commerce Studies is doing, from that they are earning profits. Those profits are taxable to them under which head? They are taxable to them under the head PGVP. They are into business, the profits are taxable to them under the head PGVP. Now Inside Commerce Studies, while making payment of salary to their employees, they have deducted some employees' contribution. That employees' contribution is a liability for Inside Commerce Studies, but Income Tax Act says that please consider this as income. So this amount will be added to the PGVP income of Inside Commerce Studies. Thereafter, they will be asked to deposit this amount in the employee's retirement fund account within the due date. If they are depositing this amount in the employee's retirement fund account within the due date, then deduction will be allowed to them. So this employee's contribution will be added to the income, it will also be deducted. But if this is deposited in the employee's retirement fund account after the due date, then it will be only added, it will not be deducted. If it is only added, it is not deducted, then employer's PGVP income will increase, as a consequence of which his tax liability will also increase. Have you understood this? Yes or no? Okay, listen to me very carefully. I move on to the left hand side in this flow chart. Activities carried on by the SSE is in the nature of either business or is in the nature of profession. Activities carried on by the SSE is in the nature of business or it is in the nature of profession. In that case, employees' contribution shall be includable under the PGVP, and corresponding deduction is also allowable under that PGVP in section 36 subsection 1 clause 5. In section 36 subsection 1 clause 5a. Now let me give you one more example. Listen to me carefully. Say for example, I am one of the employee of Inside Commerce Studies. I am one of the employee of Inside Commerce Studies. So they would pay salary to me every month. They would pay salary. They are paying me salary. And in my house, I have appointed a domestic servant. In my house, I have appointed a domestic servant for cleaning, etc. Am I supposed to maintain provident fund for the benefit of my domestic servant? Dikshit, wait for some time. Give me some time. Have you understood everything written on the left hand side? Dikshit, assessment means assessing the income. Assessment means assessing the income, ascertaining the income, and ascertaining the tax liability. In the basic concept chapter, we had the definition of assessment. Na? Assessment includes reassessment. Assessment includes reassessment. SSE. SSE also we had definition in the chapter of basic concept. In the chapter of basic concept, we had a definition of SSE. You did not attend the first chapter? Here also meaning is same. Here also meaning is same. Here SSE means you can understand is employer. Listen to me. I'll explain. Don't worry. Don't worry. Listen to me carefully. Let me go back to the same example. Inside Commerce Studies is running a coaching class. They have hired more than 20 persons. For them, it is mandatory to maintain provident fund for their employees. They have maintained a provident fund. They are paying salary to their employees. While paying salary to their employees, they have deducted employees' contribution towards the provident fund. This employees' contribution towards the provident fund is an liability for the inside Commerce Studies. But Income Tax Act says that kindly consider this as income of inside Commerce Studies and add this to their PGBP income. Thereafter, ask them to deposit this money in the employee's retirement fund account within the due date. If they are depositing this money in the employee's retirement fund account within the due date, then give them deduction while computing their business income in section 36 subsection 1 clause 5. So in this example, SSE means inside Commerce Studies. So we are thinking from the point of view of inside Commerce Studies. Have you understood, Dikshit? Yes. So this is over. Now I am taking you through one more example, that in fact income from other sources is including only this part. Income from other sources including only this part. I have explained you so many things pertaining to different chapters, so that you have a better and overall understanding of the provisions. Now listen to me carefully. I am taking another example. I am working as an employee of Inside Commerce Studies. I am working as an employee of Inside Commerce Studies. They are paying me salary every month. Now in my house, I have kept a domestic servant. I will pay salary to him. I am talking about second situation. I have appointed a domestic servant in my house. I am paying salary to him. I am not supposed to maintain any provident fund for him, because I have not hired 20 or more persons. So Provident Fund Act is not applicable to me. But still, I am a very positive person. I am a very helpful person. So I asked that domestic servant, what if you retire? After your retirement, how will you live your life? Have you thought about that? So he says, sir, I am uneducated. So I'll have to work till I die. I don't have any savings. I don't have any retirement fund. So I will have to work till I die. So I told him, do one thing. Whatever remuneration I am paying you every month now, from that I would deduct certain amount. I am paying you remuneration of 5,000 per month now. Out of 5,000, I would deduct 1,000 rupees. I would pay only 4,000 to you. I will also contribute 1,000 from my own pocket. Every month 2,000 I will deposit in your provident fund account. Let me create provident fund for you. I will deposit 2,000 every month in this provident fund account. Till the time you are working with me, every month 2000 savings will be done for your benefit. And when you retire, if you work with me only throughout your life, then when you retire, that entire provident fund balance will be given to you. So you'll have some retirement fund. So you can live your life properly after retirement also. So he readily agreed. I am deducting 1000 rupees from his salary. I am also contributing 1000 from my own pocket, and 2000 I am depositing in his retirement fund account in his name. Now the point is, my income which I am earning from Inside Commerce Studies, I am an employee of Inside Commerce Studies. Whatever I am earning from Inside Commerce Studies is income from salary for me. My income is not taxable under that PGBP. My income is taxable under income from salary. Now government says, from your domestic servant's salary, you have deducted something now. That amount should be considered as your income. And then, if you deposit that amount in the employee's retirement fund account within the due date, then we will allow the deduction also. But since your income is not taxable under that PGBP, we are making similar provisions under that IFOS for you. So government has created provisions under that IFOS. Whatever 1000 rupees which I am deducting from my domestic servant's salary, that 1000 rupees will be considered as my income under the head IFOS. This is because of section 56, subsection 2, clause 1C. So employee's contribution, if the activity is carried on by SSC, here I am SSC, Dikshit, in this example I am SSC. Well, left hand side I gave you example now. Inside Commerce Studies was SSC. Right hand side example, I am SSC. Left hand side there was a transaction between me and Inside Commerce Studies. Right hand side there is a transaction between me and domestic servant. So you can safely say yes, employer is SSC here. Employer is SSC. Now, my income which I receive from Inside Commerce Studies is taxable under income from salary. My activities are not in the nature of business profession. So activities carried on by the SSC, they are not in the nature of business profession. In that case, employee's contribution which I have deducted from domestic servant salary will be includable under their income from other sources because of section 56, subsection 2, clause 1C. Section 56, subsection 2, clause 1C. And corresponding deduction will be allowed in section 57. Corresponding deduction will be allowed in section 57. Means the amount which I have deducted from domestic servant's salary, if I deposit that amount in the provident fund account within the due date, then deduction will be allowed to me for that amount in section 57. Have you understood this? Yes or no? Yes. So we have completed this point number 3. Now we are left with point number 4, 5, 7 and 8. So we'll have a break. After the break, we'll complete these 4 points and then we'll also discuss remaining practical questions and this chapter will get completed. Maybe before the second break itself, this chapter will get completed. And today we are moving on to the very important chapter, that is deduction from gross total income. So, we will be starting with the chapter of deductions. So, point number 3 is over. Point number 3 is over. We are moving on to point number 4. Point number 4 talks about interest income. Point number 4 talks about what? It talks about interest income. See, in Income Tax Act, they have not written when interest is taxable. They have written when interest is exempt from tax. They have made different sections wherein interest is not taxable, it is exempt from tax. If the interest earned by you is not falling in the list of exemption, if the interest earned by you, if it doesn't fall in the list of exemption, then automatically it will become taxable. Then automatically it will become taxable. So I have divided this flow chart in two parts: interest income. When that interest income is taxable and when that interest income is exempt from tax. We have three sections relating to exemption: section 10 clause 11, section 10 clause 12 and section 10 clause 15. On the next page, that is on page number 246, the first section is section 10 clause 11. Interest earned from Public Provident Fund Scheme 1968 shall be exempt from tax. Any amount which is received by you on maturity of PPF scheme, that amount will become taxable. That amount will be exempt from tax, including interest. Including interest. So, interest income earned by you on Public Provident Fund balance, PPF balance, is exempt from tax in section 10 clause 11. Then we have section 10 clause 12. We also have section 10 clause 12. Accumulated balance due and becoming payable to employee participating in recognized provident fund is exempt. When an employee withdraws money from recognized provident fund, if that 5 years of continuous service condition is fulfilled, if the 5 years of continuous service condition is fulfilled, then what will happen? Amount withdrawn is totally exempt from tax. That amount withdrawn will also include the interest balance. That will also be totally exempt from tax. Next is section 10 clause 15. Next is section 10 clause 15. Interest on certain securities, bonds, savings certificate, other certificates issued by the government, they are exempt from tax in section 10 clause 15. So we have list of incomes, list of interest incomes which are exempt from tax. We have the list of interest incomes which are exempt from tax, and that is given in section 10 clause 15. First of all is point number 1, interest on post office savings account. Interest on post office savings account. Listen to me very carefully. We'll always try to do the comparison. Interest on post office savings account. Here you get the exemption if you are having a single account. If you are having a single account, then exemption is 3,500. Exemption is 3,500. If you are having a joint account, then exemption is up to 7,000. Joint account means account which is in the name of multiple persons. So if you are having a single account, whatever interest you have earned on savings account with post office. See, Indian Postal Services is also a bank. Indian Post Office is also a bank. So you can have a savings account with Indian Post Office as well. If you are having a savings account with Indian Post Office, then whatever interest you have earned, out of that certain portion will be exempt in section 10 clause 15. If you are having a single account means account is in only your name, in the name of only one person. In that case, interest up to 3,500 would be exempt from tax. Interest earned up to 3,500 would be exempt from tax. Whereas on the other hand, if it is joint account, if it is a case of joint account, then interest will be exempt to the tune of 7,000 rupees. Now, very important point to be noted here is, if you are having a saving account with bank, if you are having a saving account with bank, then that interest is fully taxable. Exemption is available only if you are having a saving account with post office. If you are having saving account with bank, that interest is fully taxable. Next is interest on post office cumulative time deposit rules. Interest on post office cumulative time deposit rules. See, cumulative time deposit means it is as good as FD only, but you are going to receive interest at the time of maturity. You are going to receive interest at the time of maturity. So, interest earned on post office cumulative time deposit rules 1981, that is exempt from tax. Next is fixed deposit scheme governed by the post office FD rules 1968. So, if you are having an account with post office in FD rules, fixed deposit under the FD rules 1968 or fixed deposit under the cumulative time deposit rules 1981, that entire interest will be exempt from tax. What if you are having a fixed deposit with bank? Then that interest is totally taxable. If you are having a fixed deposit with bank, that interest is totally taxable. So listen to me carefully, I am repeating. If you are having a savings account with post office, single account 3,500 interest is exempt, joint account 7,000 interest is exempt. But interest on a savings account with bank is fully taxable. FD account with the post office under post office CTD rules, post office FD rules, that interest is totally exempt from tax. But if you are having a fixed deposit with bank, then your interest is fully taxable. See, what is taxable is not written. I am just telling you. This is also taxable. So, point number 1 is over. Point number 2. Interest on RBI relief bonds. Interest on RBI relief bonds, if it is earned by individual or HUF, it is exempt from tax. Interest on RBI relief bonds, if it is earned by individual and HUF, it is totally exempt from tax. Next is point number 3. Next is point number 3. Interest on notified bonds. What do you mean by notified bonds? CBDT will issue the notification. CBDT will issue the notification and it will notify which interests are exempt from tax. So, whenever CBDT notifies any bonds, debentures, government securities, etc., the interest earned from those notified government securities, bonds, debentures, etc., would be totally exempt from tax. It would be totally exempt from tax. So, interest on notified bonds or debentures of public sector company, if the bonds or debentures are notified, interest would be exempt from tax. Certain bonds, debentures which are notified by the central government as tax-free bonds. These are tax-free bonds notified by the central government, no tax will be levied. Bond issued by India Infrastructure Company Limited, these are tax-free bonds. Bond issued by Indian Railway Financial Corporation Limited. Can you recollect? Can you recollect section 54 EC from Caplican relating to exemption? If you have sold land, building or both and you have acquired the bonds of NHAI, REC, Indian Railway Financial Corporation Limited, Power Finance Corporation Limited, whatever investment you have done there in bonds, the interest income earned from those bonds will be totally exempt from tax in section 10 clause 15. Yes, are you getting my voice clearly? So, bonds of Indian Railway Financial Corporation Limited, bonds of National Highway Authority of India, bonds of Rural Electrification Corporation Limited, bonds of Power Finance Corporation, these 4 bonds were even covered by section 54 EC. So, when you invest money in these bonds, You claim exemption in section 54AC, and whatever interest is earned on these bonds, that is totally exempt from tax in section 10 clause 15. In capital gain, it is section 54EC. That is the section relating to exemption, exempting your capital gain. Here they are exempting your interest income from bonds. They also have written bonds of HUDCO, Housing and Urban Development Corporation Limited, bonds of Jawaharlal Nehru Port Trust, Dredging Corporation of India, Ennore Port Limited, Indian Railway, Indian Renewable Energy Development Agency Limited, bonds of all these companies. If you invest money in bonds of these companies or debentures of these companies, the interest would be totally exempt from tax. Then we have point number 4. Notified bond issued by local authority or state pooled finance entity. Notified bonds issued by local authority or state pooled finance entity. Say for example, Chennai Municipal Corporation is issuing bonds with the intention of creating one more metro line. They have decided to build a metro train here. So for that they need funds. So they have issued the bonds. So Chennai Municipal Corporation has issued bonds. They will raise the funds and they will make the metro. So if these bonds are notified, if the Chennai Municipal Corporation is requesting the government to notify these bonds, and government feels that yes, this is in public interest, we should notify, and if government notifies these bonds, then interest will be totally exempt from tax. So the most important word here is notified. These bonds, these debentures should be notified. If they are notified, interest is exempt. So notified bond issued by the local authority or state pooled finance entity. State pooled finance entity means a financing company of the state government. Financing company of the state government. Then we have point number 5. Interest on gold deposit bond issued under the gold deposit scheme 1999 or deposit certificate issued under the gold monetization scheme 2015 issued by the central government. If you still recollect, gold deposit bonds issued by the central government, they are not considered as capital asset. So at the time of redemption of gold deposit bond, if you receive the gold, that will not become taxable. We have solved question number 5 on that. And the interest earned by you on this gold deposit bonds, that interest will be totally exempt from tax. Let's move on to point number 6. Interest income receivable by a non-resident from a unit located in International Financial Service Center is exempt from tax with effect from 1st September 19. This is not important for you. I have already told you in the chapter of capital gain while discussing section 111A as well as 112A, saying that this International Financial Service Center not yet started in India. So if you earn interest income and this interest income is earned by a non-resident from a unit located in International Financial Service Center, that interest will be exempt. So not yet started, when the activities would start, they can claim the exemption. So here we have gone through those interest incomes which are exempt from tax in section 10 clause 15. They are exempt from tax in section 10 clause 15. Now look at this page, page number 245. Page number 245, look at this. When the interest is exempt from tax, when the interest is exempt from tax, you cannot claim deduction for any expenditure which you might have incurred for earning those interest income. See, if your interest is exempt, your income itself is exempt. Government is not levying tax on income itself. If government doesn't levy tax on income, how can you ask for deduction? For example, you have taken a loan from bank at 10% per annum and you have invested money in the debentures and you are earning an interest of 12%. That entire 12% interest is exempted to you. Tax is not levied. Then you can't say whatever interest I am paying on a loan, please give me deduction. From what we will give you deduction? Your entire income is exempted. So, if your income is exempt, if your income is exempt, then deduction cannot be claimed for any expenditure incurred for earning the income or for collecting the income. Expenditure cannot be claimed as deduction. Expenditure which is incurred for either earning the income or collecting the income, those expenditure cannot be claimed as deduction. Those expenditure cannot be claimed as deduction. That is written in section 14A. That is written in section, it is written in section 14A. Yes, have you understood till now? Yes or no? Yes. So now I move on to the most important part of this topic. This is the most important part. One point I have not discussed with you while explaining you dividend income. Yesterday, when I explained you dividend income, one point intentionally I have not explained it to you. That point of dividend income, I'll explain you along with this point. Now listen to me carefully. You earn interest from securities. You earn interest from securities. The word securities is much wider in scope. It will include bonds, it will include debentures, it will include government securities, etc. If those securities are held by you as stock in trade, if those securities are held by you as stock in trade, then interest income is taxable under the head PGBP. If those securities are held by you as stock in trade, then interest income is taxable under the head PGBP. Whereas, if those securities are held by you as investments, if those securities are held by you as investments, then interest income is taxable under the head IFOS. Definitely, this is the normal understanding. Anything which you earn from your stock in trade should be taxed to you under the head PGBP, and anything which you earn from your investment should be taxed to you under the head IFOS. So this is logical and this is as per the normal understanding. So if the securities are held by your stock in trade, interest income will be taxable under the head PGBP. If the securities are held by you as investments, then your interest income will be taxable to you under the head IFOS. And very, very important point. Since these interest incomes are taxable, whatever expenditure you might have incurred, for earning this income, those expenditure can also be claimed as deduction. And you know, under the IFOS, which section is granting your deduction, which section is giving you deduction? That is section 57. That is section 57. So here we have written, since the above incomes are taxable, deduction can be claimed for expenses incurred for earning the income and for collecting the income. Where you can claim deduction? If your income is taxable under the head PGBP, go and claim deduction in PGBP. If your income is taxable under IFOS, we will give you deduction in IFOS in section 57. Sarvana, stock in trade means a dealer. A stock in trade means when the share market opens and you purchase the shares today, you sell the shares today, or you purchase the shares today itself at morning 10 o'clock and you sold at 1 o'clock. In that case, we say that you are a dealer in shares. You are acquiring the shares frequently, you are selling the shares frequently. Similarly, if you acquire the securities frequently and you sell the securities frequently, the securities are also listed. Securities are also listed. So you can buy the securities from the open market and sell the securities in the open market. So if you are buying the securities and selling the securities with the intention to earn some profit out of those transactions, then we say those securities are held by you as stock in trade. Your intention is not to earn the interest income of out of those securities, but you are buying the securities and selling the securities, and you know that you might have learned the chapter of investment accounting. You might have learned the chapter of investment accounting. In that, you might have studied that you receive the interest on a specific date now. You receive the interest on a specific date, and these securities are quoted either at cum interest price or ex interest price. Have you heard about all these things in the chapter of investment accounting? Yes or no? Yes? Okay. So, if you are holding the securities as stock in trade, but during that holding period, say for example, you are holding securities only for 10 days. During those 10 days, you received interest and you sold off the securities. In that case, we say that you earned interest income from those securities which were held by you as stock in trade. These were held by you as stock in trade. So, this point number 4 we have completed, but I want to connect this point with similar point for dividend. I want to connect this point with similar point for dividend, and that point is written on page number 240. That point is written on page number 240. Look at this, just below section 8, we have written these important points. You can mark this as very important. In fact, it is not important, it is very important. If the shares are held as investment, if the shares are held as stock in trade, if the shares are held as stock in trade, definitely dividend income should be taxable under the head PGBP, and shares are held as investment, dividend income should be taxable under IFRS. This is the way in which you might be thinking naturally, but this is not the correct answer. This is not the correct answer. Here we are saying that if shares are held as investment, your dividend income is taxable under IFRS. Even if the shares are held as stock in trade, still your dividend income is taxable under IFRS only. So here we are talking about shares. If those shares are held as investment, your dividend income is taxable under income from other sources. If your shares are held as stock in trade, in that case also dividend income is taxable under IFRS. Generally, any income earned from stock in trade is taxable under PGBP, but here exceptionally it is taxable under IFRS because government has clearly specified that dividend income will always be taxable under the head IFRS. Dividend income will always be taxable under the head IFRS. So, do you believe that the rules are same for shares and securities, or they are different? Yes? Are you understanding? Are you getting my voice? Yes? Securities are held as stock in trade. Securities are held as investment. They are different. So if securities are held as stock in trade, if securities are held as stock in trade, your interest income is taxable under that PGBP. On the other hand, if the securities are held as investment, then your interest income is taxable under income from other sources. But that is not the case with shares. That is not the case with shares. If the shares are held as stock in trade, Ideally, your dividend income should be taxable under the head PGBP. Ideally, your dividend income should be taxable under the head PGBP. But government specifically says this would be taxable under income from other sources. Similarly, if the shares are held as investments, in this case, logically your dividend income should be taxable under IFOS only. So everything is logical. Everything is logical. But here there is some problem. Here it is something illogical which your mind will not be in a position to digest, but this is fact. This you tend to forget. Mark this as very important. So dividend from shares held as stock in trade is not taxable under that PGBP. Is not taxable under that PGBP. It is taxable under the IFOS. Yes. Have you got this very clearly? Sarvana is asking me, sir, section 36 subsection 1 clause 15. Sarvana, section 36 subsection 1 clause 15 is securities transaction tax. Securities transaction tax. If the shares or securities are held by a stock in trade, whenever you trade through a stock exchange, you pay securities transaction tax. That securities transaction tax you can claim it as deduction. That securities transaction tax you can claim it as deduction in section 36 subsection 1 clause 15. Is that very clear? Have you understood this? Dividend interest, dividend income, interest income, the provisions are slightly different. So with this we have completed point number 4. Now which point is left? Point number 5 is left. So let's move on to point number 5. Now I move on to point number 5. Point number 5 is income from letting of plant, machinery, furniture. See, here you have not let out the building, you have only let out the asset. If you let out the building along with asset, then it is point number 6, composite rent, composite income, already discussed in the chapter of income from house property. Here you are only letting out the plant, machinery and furniture. Here you are only letting out the plant, machinery and furniture. If letting out plant, machinery, furniture is a regular activity for you, if it is a regular business activity for the SSE, then income from letting out of plant, machinery, furniture should be taxable under which head? It should be taxable under the head PGBP. PGBP. And whatever expenditure you might have incurred in connection with letting out plant, machinery, furniture, you can claim it as deduction while computing your business income. Which are those expenses? You might have incurred some expenses relating to plant, machinery, furniture, repairs, insurance. You can claim it as deduction in section 31. You can claim deduction for depreciation of plant, machinery, furniture. You can claim deduction for other expenditure incurred for earning the income and other expenditure incurred for collecting the income. You can claim deduction in section 37 subsection 1. You can claim deduction in section 37 subsection 1. So whatever rent you have received, whatever rent is received from letting of plant, machinery, furniture, whatever rent you have received from letting of plant, machinery, furniture will be taxable to you, under your PGBP, and all the expenses which are incurred in connection with those plant, machinery, furniture can be claimed by you can be claimed as deduction by you under the PGBP in section 31, section 32 and section 37 subsection 1. Same to same things we have written on the right hand side also. But what difference we have on the right hand side? Here letting out is not a regular activity for the SSE. Letting out is not a regular business activity. If letting out of plant, machinery, furniture is not a regular business activity for the SSE, then the rent received from letting out of plant, machinery, furniture will be taxable under the income from other sources, and same expenditure you can claim it as deduction. You can claim deduction for rent, repairs, rates and taxes, insurance, depreciation, any other expense. But deduction will be allowed where? In section 57 clause 2. Deduction will be allowed in section 57 clause 2. Once you claim the deduction, the balance income will be taxed to you under income from other sources. So, if letting out the plant, machinery, furniture is a regular business activity for you, your income can be taxed under that PGAP. If letting out plant, machinery, furniture is not a regular business activity for you, your income will be taxable under the head income from other sources. So, with this we have completed point number 5 as well. Now, I think we are left with point number 7 and point number 8. Once we complete this point number 7 and point number 8, our discussion of this chapter will come to an end. But just before I give a break, Sarvana has sent me a message saying that, sir, please explain section 2 clause 22 subclause E. So, I think that there are certain points below section 2 clause 22 subclause E that has skipped my mind, I have not discussed with you. So, those points also I will be discussing, and then we will move on to practical questions. So, first of all, now let us move on to this point number 7. Point number 7 talks about keyman insurance policy. It talks about what? Keyman insurance policy. I have written the theory here, same thing. I have made a flow chart here, diagram for you. This will help you to understand what is keyman insurance policy and what is the tax treatment if some money is received on the maturity of keyman insurance policy. So, you can just refer this distinction table and you can refer this flow chart day before examination. That's all. See, relating to keyman insurance policy, we have sections in 3 different chapters. We have one section in the chapter of income from salaries, that is section 17 subsection 3, profits in lieu of salary. There one point was keyman insurance policy. I have not explained you in the chapter of income from salaries. If you refer to the chapter of profits and gains of business profession, there also you have keyman insurance policy in section 28 charging section. And if you refer to the chapter of income from other sources, here also you are having keyman insurance policy, and the section is section 56 subsection 2 clause 4. So, we have 3 different sections in 3 different chapters for charging tax on something received under a keyman insurance policy. So, now it is the right time for us to understand this entire concept. So, all these sections which are there in different chapters, all they are taken together and one small diagram is made. This will help you to understand the entire taxability of keyman insurance policy in the Income Tax Act. But before we move on to discuss that, let us try to understand what is the difference between a keyman insurance policy and a life insurance policy. What is the difference between a keyman insurance policy and a life insurance policy? See, life insurance policy is taken for the financial security of dependents. It is taken for the financial security of dependents. Meaning thereby, if something happens to you, your dependents will be financially compensated. So if something happens to you, your dependents should not have a emotional shock as well as the financial shock both at the same time. So you take the life insurance policy to ensure that your dependent persons are having some financial security. Maturity proceeds of this life insurance policy is generally exempt in section 10 clause 10d. Maturity proceeds of this life insurance policy is generally exempt in section 10 clause 10d. But yes, in certain cases, even the maturity proceeds of life insurance policy is taxable. That I will discuss with you in the next chapter, that is deduction from gross total income. But right now, you can take it from me saying that maturity proceeds of life insurance policy is exempt in section 10 clause 10d. So we have discussed point 1, life insurance policy. Why the life insurance policy is taken and what is the treatment of maturity proceeds of life insurance policy that we have discussed. I have given you one disclaimer saying that when I move on to the chapter of deductions from gross total income, I would explain you that there are certain situations where even the maturity proceeds of life insurance policy is taxable. But for the time being, you can understand that maturity proceeds is exempt from tax in section 10 clause 10d. Have you understood this life insurance policy part? Yes or no? Yes. Now you take that Keyman insurance policy, take 30 seconds and refer it very quickly. Refer it very quickly. Take 30 seconds. Yes, have you referred? Yes, okay. So tell me, what is the difference between a life insurance policy and a Keyman insurance policy? Life insurance policy is taken for financial security of dependent person. So if you are the earning member of your family and if all others are dependent on you, and in that case you should take life insurance policy, because if something happens to you, they will have a financial insecurity. So to provide them financial security, you should take the life insurance policy. Keyman insurance policy is taken for protection of business. Have you learned the chapter called as fire insurance claim in accountancy? In accountancy, you have learned the chapter of fire insurance claim now. There was something called as loss of stock policy and loss of profit policy. Loss of profit policy is taken to compensate the loss which you have incurred for disturbance in the business. If fire takes place in your premises, then you will not be in a position to do the business in the normal manner. In that case, definitely you will have a loss because of the opportunity which you have lost. You have lost an opportunity to earn the revenue. That is also a loss for you. To compensate that loss, if you take the loss of profit policy, then the insurance company will compensate you. Similar to that, Keyman insurance policy is also on the same footing. Say for example, Reliance Industries Limited. In Reliance Industries, Mr. Mukesh Ambani is a very shrewd businessman. He takes all the right decisions at the right time and is a very quick decision maker. If he is absent from business, maybe he has fallen sick, or he has gone into coma, or he has died, then in that case, business can be impacted to a very huge extent. So Reliance Industries Limited may take a keyman insurance policy on the life of Mr. Mukesh Ambani. In that case, if something happens to Mukesh Ambani, because of his absence, business may suffer loss for certain span of time. See, no person in this world is indispensable. Everyone is replaceable. But it would take some time, na? If Mukesh Ambani dies, someone else will take his position. But it will take some time for that new person to learn the intricacies of business. During that phase, business may incur the losses. To compensate for that loss, you may take a policy called as keyman insurance policy. So keyman insurance policy is taken on the life of individual, but it is not taken for the benefit of individual. It is taken for the benefit of business. It is taken for the protection of business. Maturity proceeds of keyman insurance policy, they are fully taxable. They are fully taxable. So maturity proceeds of life insurance policy is exempt from tax, whereas maturity proceeds of keyman insurance policy is fully taxable. Now let us try to understand. Now our focus is now shifted to keyman insurance policy. I have made a small diagram for you covering all the sections. Say for example, here there is an organization who is taking the keyman insurance policy. That organization will be called as an insured person. For example, this organization is say Reliance Industries Limited. This is Reliance Industries Limited. Reliance Industries Limited has taken a keyman insurance policy on the life of Mr. Mukesh Ambani, and this policy is taken from an insurance company, say LIC of India. So Reliance Industries Limited would be paying premium to LIC. That premium, that insurance premium on keyman insurance policy is an expenditure for Reliance Industries. They would claim deduction under section 37 subsection 1. They would claim deduction under section 37 subsection 1. Now there are different possibilities. Now first of all you tell me, if something happens to Mukesh Ambani, that compensation will be received from insurance company. Who will receive the compensation? Family of Mr. Mukesh Ambani will receive the compensation, or Reliance Industries would receive the compensation? Who will be the beneficiary? Definitely Reliance Industries Limited. Business would be the beneficiary. Compensation would be received by Reliance Industries Limited. So here we say that if policy is not assigned to key person, when the policy is taken, beneficiary is Reliance Industries, and that policy is not assigned to keyman. See, this policy which is taken by the company, can be assigned to keyman. Here we are saying that policy is not assigned to keyman. Policy is in the name of company only. So company is the beneficiary. If something happens to Mr. Mukesh Ambani, Reliance Industries Limited would receive the compensation from the insurance company, and that maturity proceeds compensation would be taxable to them under the head PGVP under section 28. Will be taxable to them under the head PGVP under section 28. Is that very clear? Yes or no? Now let's move on to the right hand side. Right hand side, I am taking two examples. Listen to me carefully. Say for example, Dixit has completed his chartered accountancy and is specializing in income tax practice. In the entire city of Chennai, he has made his own name. People know him that if you want to know something about income tax, you go to Dixit. Reliance Industries Limited has appointed Dixit as consultant for income tax purposes. Now say for example, Reliance Industries Limited has also taken the Keyman insurance policy for Dixit. Reliance Industries Limited believes that Dixit is an important person for our organization. In his absence, we'll have to pay more tax. He's excellent tax planning. He can do a tax planning in an excellent manner. So, if Dixit is not available, then we don't have a person who can plan our taxes. So, we'll have to pay more taxes. So, Reliance Industries Limited believes that Dixit is a very important person for them. So, they have also taken the Keyman insurance policy on the life of Dixit. Now, somehow through the grapevine communication, Dixit came to know about this, saying that Reliance Industries Limited, they have taken the they have taken the Keyman insurance policy for me. He took the advantage of this situation and he resigned from the position of consultant. And the moment he resigned from the position of consultant, he was asked to meet personally to Mr. Mukesh Ambani. So Mukesh Ambani asked him, why you are resigning from the position? He says that no, I am working with different companies, so I don't have that much time that I can devote time to every company. That is the reason I am resigning. I don't have time to manage all these things. So Reliance Industries is saying, if you want to resign from some other company. Now, why our company? So Dixit says, your company is paying me the lowest remuneration. That is the reason. Others I am rendering services, so they are providing me more remuneration. And you are providing me less remuneration. So I need to resign from some company to make some free time for me. So those companies who are paying me less remuneration, I have resigned. So Mukesh Ambani says, you tell us how much remuneration you want. You just tell us what do you want. You should not resign. Take back your resignation. Taking the advantage of this situation, Dixit said, sir, do one thing. You transfer that Keyman insurance policy in my name. Reliance Industries Limited has taken a Keyman insurance policy for me in my name for 5 crores. You transfer that policy to me. Then I will take back my resignation. Dixit had hit the hammer when the iron is hot. He has taken the advantage of this situation. And Mukesh Ambani said, let me have the discussion with other board members and I will let you know. He had the discussion with other board members and Reliance Industries Limited has transferred that Keyman insurance policy to Dixit. Means Reliance has assigned the policy to Dixit. In that case, Dixit will become the beneficiary. Dixit will become the beneficiary. Are you understanding? Yes or no? Now in the same example, let me say that Sarvana has also cleared his chartered accountancy. He has joined Reliance Industries Limited as an employee. Dixit is working with Reliance Industries as consultant. Sarvana is working with Reliance Industries as an employee. Sarvana came to know that her company has transferred the Keyman insurance policy to Dixit. Sarvana also resigned. He also resigned. Once again the same thing happened. He had a meeting with Mr. Mukesh Ambani and he told that you should transfer that Keyman insurance policy to me. His Keyman insurance policy is also transferred to him. So now Reliance had taken 3 Keyman insurance policy. One on the name of Mr. Mukesh Ambani, one for Sarvana, one for Dixit. Mr. Mukesh Ambani and Sarvana both are employees of the organization. Dixit is a consultant. Policy which is taken in the name of Mr. Mukesh Ambani that is not assigned to him, in that policy, company is the beneficiary. So at the time of maturity, whatever amount is received by the company will become taxable to the company. Under which head? PGBP. Under which section? Definitely section 28. But in case of Sarvana and in case of Dikshit, the policy is assigned to keyman. Policy is assigned to keyman. So now company is no more the beneficiary in this policy. Who is beneficiary? Keyman is the beneficiary. Keyman is the beneficiary means at the time of maturity, amount will be received by the keyman, not by the company. So Sarvana is an employee. So here we say assignee. Assignee means the person to whom the policy is assigned. Sarvana is an employee. Policy is assigned to him. In future, maturity proceeds are received by Sarvana will be taxable to him under the income from salary in section 17 subsection 3 called as profit in lieu of salary. Dikshit is not an employee, he is a consultant. So policy is assigned to Dikshit. Here assignee is not an employee. Assignee is not an employee. On the left hand side, assignee was employee. Right hand side, assignee is not an employee. If assignee is employee, maturity proceeds received by him, taxable to him under section 17 subsection 3. If assignee is not an employee, maturity proceeds are received by him, they are taxable to him under income from other sources. They are taxable to him under income from other sources. Is that very, very clear? Yes or no? Okay. We have completed this point. Now we are left with only one point here. That is point number 8. All this theory which is given here you should read. But ultimately this is the crisp diagram. Now I want to explain you point number 8. For that I am going to take an example. Listen to me very carefully. Now I am moving on to which point? Point number 8. Section 56 subsection 2 clause 7b. Section 56 subsection 2 clause 7b. This is very, very important. For understanding this, lot of application of mind is required. So you need to focus here. If you focus 100%, you will understand 50%. For understanding 100%, you will have to focus 200%. Let me take an example. For example, I am having huge amount of black money. I am having huge amount of black money. And you all are having huge amount of white money. If you all gift me that white money, it will become taxable to me under the IFOS if the aggregate gift is more than 50,000. So there is no way out wherein you can transfer your white money to me. I can definitely transfer black money to you. Just I'll pack that cash in a bag and I'll send that bag to your home. So I can easily transfer my black money to you, but you cannot transfer your white money to me. So after the introduction of gift and property acquired for inadequate consideration provisions, it was very difficult for people to convert their black money into white. So few people came out with a totally altogether different idea and converted his black money into white. This situation was caught by the government, and then government inserted section 56 subsection 2 clause 7b. Let us try to understand how this entire gamut was made, how this entire arrangement was done. All this is done only with the intention to ensure that I convert my black money into white. So I am an individual having huge amount of black money. My intention is to convert my black money into white, but for that purpose I will take help from each one of you. So first of all, what I am doing is, I have created a private company, J Private Limited. I have created a private company, J Private Limited. In this private company, there is only balance sheet, no profit and loss account, no activity at all. So balance sheet liability side, you have 1 lakh shares of 10 each. Balance sheet liability, you have 1 lakh shares of 10 each. So share capital 10 lakhs. Balance sheet asset side, bank balance. Balance sheet liability side, share capital 1 lakh shares of 10 each. And balance sheet asset side, you have a bank balance. That's all. You don't have anything else. Now you just tell me, if I ask you to buy the shares of this company, how much amount you would be ready to pay per share? If I ask you to buy the shares of this company, this is a private limited company, you are a chartered accountant student, you have learned the subject of financial management, ratio analysis, what not. If I ask you to buy the shares of this company, you would be ready to pay how much amount per share? Definitely, you would try to calculate the net asset value per share. Assets minus liabilities divided by number of shares. So asset is 10 lakh, outside liability is 0, divided by number of shares 1 lakh. So intrinsic value or net asset value per share turns out to only 10 rupees. So you would say that yes, I am ready to buy the shares of this company only at 10 rupees per share. In fact, that too I should not buy because company is not having any business operations only. But still, if at all you force me, I will buy the shares of this company only at 10 rupees. Because you have calculated net asset value per share. Because you have calculated net asset value per share. Now see what is happening. J Private Limited, this company is issuing 1 lakh shares of rupees 10 each. 1 lakh shares of rupees 10 each at 1000 rupees per share to 100 investors. J Private Limited is issuing 1 lakh shares of 10 each at 1000 rupees to 100 investors. Say for example, each one of you are investor in this company. So you all have given 1000 rupees. Which money? White money. So 1000 rupees per share multiplied by 1 lakh shares. You think from the point of view of company. From the point of view of company would receive 1000 rupees per share on 1 lakh shares. So get me the amount. Old share capital was 1 lakh shares of 10 each. New shares are issued 1 lakh shares of 10 each. So the share capital revised amount is 20 lakhs. Share capital revised amount is 20 lakhs. Then you have securities premium 1 lakh shares of 990 each. You have the amount of 9 crore 90 lakhs. And the asset side you have the amount 10 crore 10 lakhs. Your balance sheet will tally at 10 crore 10 lakhs. Your balance sheet will tally at 10 crore 10 lakhs. So you all have agreed to purchase the shares of this company at 1000 rupees. So you have purchased the shares at a very high premium and you have transferred 1000 rupees per share white money to this company. Can you tell me what will be the net asset value per share after this transaction based on the revised balance sheet? Yes, based on the revised balance sheet. What will be the net asset value per share or intrinsic value per share? Assets minus outside liabilities divided by number of shares. Yes, assets 10 crore 10 lakhs minus outside liabilities 0 divided by number of shares. How many shares? 2 lakh. So what is the net asset value per share? 505. 505. See, in case of public company, shares are listed on a stock exchange. If you want to know the market price of the share, you can just look at the quote on the stock exchange. But in case of private company, shares are not listed. If you want to know the real value of the shares, you have to calculate net asset value per share net worth. So here I have calculated 505 per share as the net asset value per share. So this is the first transaction. In the first transaction, company has issued shares of 10 rupees each at 1000 rupees each to the investors. And these investors have given their white money 1000 rupees per share to the company. Now I have calculated 505 rupees per share as the net asset value after the issue of shares. Now there is a one more transaction, transaction number 2. This transaction is not between the company and investor. This transaction is between me and the investor. Like individual transaction it is. Company is not involved here. So, Mr. Jignesh, I am purchasing those 1 lakh shares from those 100 investors at 505 rupees per share. So, those shares which were acquired by you at 1000 rupees, I am purchasing from you at 505 per share. By giving which money? Definitely white money. Definitely white money. So, all the shares which were acquired by the investors, they are purchased by me at 505 per share. Do you believe something will become taxable to me considering that it is acquired for inadequate consideration? No, not at all. Why? Because I have not acquired for inadequate consideration. In case of shares of private company, the fair market value is nothing but the net asset value per share. So I have acquired the shares at net asset value only. I have acquired shares having the net asset value of 505 at 505 only. So there is no inadequate consideration. Nothing can be taxed to me. So all these shares which you all investors had acquired at 1000 rupees, I have purchased from you at 505 and I have given you white money of 505. So Mr. Jignesh acquired 1 lakh shares from 100 investors at 505 per share. Now you think from the company's point of view and then you think from investors' point of view. Investors' point of view, from the point of view of investor, what is happening? He had purchased the shares at 1000 rupees. He is selling the shares at 505. So there is a loss of 495. There is a loss of 495. Yes or no? So every one of you have suffered a loss of 495. Are you understanding? Yes or no? Okay. So you have suffered a loss of 495, na? That loss I will compensate. That loss I will compensate. Instead of 495, I am giving you 510. Instead of 495, I am giving you 510. So what is your benefit? On paper, there is a loss of 495 that you can claim it as set off. But this loss is compensated by me to you by giving 510. I have given you 15 rupees extra. But this entire 510 is a black money. This is black money. I have given it in cash. So black money of 510 will be given to the investor in cash to compensate the loss. This was from your point of view, from the investor's point of view. Now you think from my point of view and my company's point of view in a combined manner. By issuing the shares, my company received 1,000 rupees white money from you. So there is a inflow of 1,000 rupees white money. There is an inflow of 1,000 rupees white money. And I bought these shares from you at 505 per share by giving you white money. I bought these shares from you by giving 505 per share white money. So there is a outflow of white money. Net to net, what is the inflow of white money? This is net inflow. This is net inflow of white money. So this 495 black money has got converted into white money. Yes or no? Have you understood this? Yes or no? Are you getting my voice? So now you don't think from your point of view. You had a loss of 495. That loss was compensated to you by giving 510. That 510 is your black money. Your white money has got converted into black money, and my black money has got converted into white money to the tune of 495. Government caught this entire gamut. Government caught this entire arrangement, and government has now made the provision for charging tax in the hands of company. Why in the hands of company? Because company's black money is getting converted into white now. So this 495 net inflow of white money will be taxable to the company. Will be taxable to the company. Yes? Have you understood this? Now let us move to the provision, what it says. Read this provision very carefully. Read this. Where a company, not being a company in which public are substantially interested, means they are talking about a private company, closely held company. Where any closely held company receives any consideration from a resident person. You all were investors, you all were resident person. My company J Private Limited was a private company. My company received consideration for issue of shares, and that consideration exceeded the face value. Face value was 10 rupees, consideration was 1,000 rupees. Means the shares were issued at premium. This provision is applicable only and only when the shares are issued at premium. Shares are issued and the consideration is exceeding the face value of such shares. Then the consideration received, as it exceeds the fair market value, to that extent it will become taxable. Consideration received in our example was 1,000. Fair market value in our example was 505. Fair market value is nothing but net asset value per share. So 1,000 minus 505 is 495. That 495 will become taxable to the company. Same thing is explained here in the form of flow chart diagram. There is a company. This company has issued shares to a resident person. Company has received consideration. If these shares are issued at discount or if these shares are issued at par, then no taxability in the hands of company. Provision is applicable only and only when the shares are issued at premium. Shares are issued at premium. Then amount taxable in the hands of company. Amount taxable in the hands of company equals to consideration received in our example 1,000 minus fair market value of shares. How much fair market value of shares? 505. What is taxable? 495. So whatever black money has got converted into white money, that amount is made taxable to the company in section 56 subsection 2 clause 7b. Yes, have you understood very clearly? I do not know whether you understood or not. Please message me. Understanding this provision requires a huge application of mind. So I have taken the example to make you understand. This example will also be sent to you. I need to send you the capital gain chapter explanation sheet as well as the solution. Income from other sources chapter explanation sheet as well as the solution. I'll upload in that WhatsApp group. So with this, point number 8 is also over. In fact, this chapter is over, but I need to still go through one point, that is dividend section 2 clause 22 subclause E. Section Section 2 clause 22 subclause E. This I had explained you. Do you remember this? Section 2 clause 22 subclause E. A private company giving loan to a registered and beneficial holder, holding 10% or more shares will be considered as deemed dividend. A private company giving loan to HUF, AOPB or a firm or company in which that same registered shareholder is holding 20% or more shares will be considered as deemed dividend. A private company paying the personal expense of registered and beneficial shareholder will be considered as deemed dividend. We have divided this in two parts to the extent of accumulated profits possessed by the company, that is the balance of reserves and surplus, non-capitalized profit. That amount will be considered as deemed dividend. Tax will be levied. Excess amount, no tax in the hands of shareholder. This I had discussed with you. But to this rule now, to this provision, there are certain exceptions. Those exceptions are given here. That 3 points are explained here. Point 1, point 2, point 3. These 3 points are covered in the diagram. But these 5 points now, exceptions, they are not covered in the diagram, that I will explain you, and then our income from other sources chapter will be completely over, and then we can move on to practical questions. Exceptions to section 2 clause 22 subclause E. Loan or advance given in the ordinary course of business. See, why the loan was given here? The intention was to transfer the company's funds to the shareholder without paying any dividend distribution tax. Therefore, the money was transferred in the form of loan. But you can't catch a genuine transaction and levy the tax, na? You can't catch a genuine transaction and levy the tax. If the company and the shareholder, they are doing such arrangement of giving the money in the form of loan with the intention to avoid the payment of dividend distribution tax, then you catch such transaction and levy tax, that is okay. But you can't catch the genuine transactions. You can't catch the genuine transaction. Therefore, here in the exception, we are having list of such transactions which are genuine. In that case, we are saying that we will not apply the provisions of section 2 clause 22 subclause E to them. First transaction is loan or advance is given in the ordinary course of business. Means that company is into the money lending business. If company is into a money lending business and company has given loan to the shareholder, company is into money lending business and company has given the loan to the shareholder, in that case, nothing will be taxable in section 2 clause 22 subclause E, because this is the ordinary business transaction. Have you understood this point? Yes or no? Yes. I'll explain you point number 2, 3 later on. But before that, let me tell you buyback of shares. Whenever there is a buyback of shares, we have discussed the treatment of buyback in the chapter of capital gain. Do you recollect? Buyback of shares, buyback of securities, We have discussed the treatment in the chapter of capital gain. So in case of buyback, we are not going to apply the provisions of deemed dividend given in section 2 clause 22 subclause E. So don't apply these provisions in case of buyback. Don't apply this provision when the shares are distributed on the demerger. Yesterday I also discussed demerger with you, na? So the shareholder of demerged company will return some shares of demerged company to the demerged company. In exchange, he would receive the shares of resulting company. In that case, you don't apply the provisions of section 2 clause 22 subclause E. So point number 1, 4 and 5 is over. Now I move on to point number 2. If company has given some trade advance, say for example, there is a registered and beneficial shareholder holding 10% or more shares, and he is a supplier of the company. He is a supplier of the company. So here, this registered and beneficial shareholder is a supplier of the company. He is supplying goods to the company. So this private company has given a trade advance to this shareholder. This private company has given a trade advance to the shareholder. This trade advance is a genuine transaction. It is a genuine trade advance. There is no intention to transfer the funds to the shareholder and avoid the payment of dividend distribution tax. There is a genuine transaction. In that case, circular number 19 of 2017 dated 12th June 2017 says a trade advance which are in the nature of commercial transactions will not fall within the word advance given in section 2 clause 22 subclause E, and they would not be treated as deemed dividend. They would not be taxed. Is that very clear? No tax on this genuine trade advance. So a genuine loan given, genuine trade advance will not catch them in the ambit of section 2 clause 22 subclause E. Now let's move on to the last point. Loan adjusted against dividend declared subsequently. Loan adjusted against dividend declared subsequently. Listen to me very carefully. There is one company, J Private Limited. There are a lot of shareholders. I am a shareholder. My spouse is shareholder. My father, my mother, my brother, my sister, my father-in-law, mother-in-law, and my grandmother. All of them are holding 10% shares in the company. All of them are holding 10% shares. Grandmother, grandfather. So we are 10 individuals. Everyone is holding 10% shares in the company. So can I say everyone is a shareholder having a substantial interest in the company? Definitely yes. This company has given a loan of say 50,000 to me. This company has given a loan of 50,000 to me. Will this 50,000 be considered as deemed dividend in section 2 clause 22 subclause E? Definitely yes. This deemed dividend will be taxed. So this loan, which is given by a private company to a registered and beneficial shareholder holding substantial interest, 10% or more shares, will be considered as deemed dividend. Up to last year, on this amount, company was paying the tax. This year onwards, shareholder has to pay the tax. Only to the extent to which you have a accumulated profits. To the extent accumulated profits are non-capitalist. Say for example, the balance of accumulated profit is 10 lakh rupees. Or say for example, the balance of accumulated profit is 10 lakhs. Let me give you the amount. Accumulated profits is 10 lakhs. Yes. So can I say entire 50,000 will be considered as deemed dividend as per section 2 clause 22 sub clause E? On this entire deemed dividend amount, tax is required to be paid. So this is the first transaction. This is the first transaction. Say for example, this happened in financial year 1920. This happened in financial year 1920. Now, there is second transaction. There is second transaction. There is a accumulated balance of 10 lakh. From this, company wants to declare dividend. Company declares dividend of 5 lakhs. Company declares dividend of 5 lakhs. In that case, don't you feel everyone would receive 50,000 each? Yes or no? Everyone would receive 50,000, right? So, company has paid say 50,000 to everyone except myself. Company has paid a dividend of 50,000 to my father, to my mother, to my brother, to my sister, to my father-in-law, 50,000 to my mother-in-law, 50,000 to my grandmother, and 50,000 to my grandfather. But company did not pay me anything. I am also eligible for 50,000 dividend. But company said that this dividend we are not paying you. This dividend we are adjusting against the loan given to you earlier. This 50,000 loan was given to you in the past, na? This we are adjusting against the dividend. So instead of paying me actual dividend, they have adjusted the loan which was given to me in the past. Now the point is, on that 50,000, tax was already paid. On that 50,000, tax was already paid considering it as deemed a dividend. Yes or no? Yes? So out of 5 lakhs, out of 5 lakh dividend distributed, 50,000 which is adjusted here, that is required to be deducted. And dividend distribution tax should be paid only on 4.5 lakhs. But from this year onwards, you know that dividend distribution tax is not required to be paid. So dividend will become taxable in the hands of shareholders. In that case, every shareholder has to pay tax on 50,000 except me, because I have not received anything. My dividend is adjusted against the loan taken by me earlier, and that loan was already considered as deemed dividend, and on that 50,000 I have already paid the tax. So when the loan is getting adjusted against actual dividend, earlier the loan was given, that loan was considered as deemed dividend, tax was levied on it. Then after subsequently actual dividend is distributed, and to that registered and beneficial shareholder to whom the loan was given, to him dividend is not actually given, that dividend is adjusted against the loan given earlier. In that case, that 50,000, on that 50,000 you need not pay the tax. That 50,000 will not be considered as deemed dividend. So loan adjusted against the dividend declared subsequently. Loan adjusted against the dividend declared subsequently. No tax subsequently. Have you understood this? Yes or no? Yes? Okay. So with this, Our income from other sources chapter is completely over. We can now just quickly move on to the practical questions and discuss. See, section 57 is also over. We can just refer it. Section 58, 59. Section 58 is for inadmissible expense. This is copied from PGBP chapter. I'll just quickly refer it. Personal expense will not be allowed as deduction. That you learned in PGBP chapter in section 37.1. Interest and salary payable outside India not allowed as deduction, is not allowed as deduction if tax has not been paid or deducted at source. Do you remember section 40 subclause A, 40 clause A, subclause 1, subclause 1A, subclause 3? All these things were discussed in the chapter of PGP, na? Subclause 1, subclause 3, 100% expenditure will be disallowed. Subclause 1A, 30% of the expenditure will be disallowed. Same thing are copied here. Income tax, wealth tax, it is not allowed as deduction. So this section is entirely copied from PGP. Income tax, wealth tax is not allowed as deduction. Expenditure of the nature of section 48 to 48.3. If you have done some excess payment to relative or amount exceeding 10,000 is paid in cash, then that will be disallowed. Same provision, same to same. Section 48 subclause 1A. If you make payment to resident person without deducting TDS, 30% of the expenditure will be disallowed. And this is the most important point. This I have discussed with you when I discussed winning from lottery, crossword puzzle, etc. No deduction shall be allowed in respect of winning from lottery, crossword puzzle, card games, etc. So, winning from lottery, etc. would be taxable at flat rate of 30%. Against this winning, you cannot claim deduction for any expense. You cannot set off any loss. You cannot set off the unexhausted basic exemption limit. Entire winning is taxable at flat rate of 30%. Yes, this is already discussed with you. Don't you feel so? Any expenditure in respect of which payment exceeding 10,000 is made otherwise than by account pay check, etc. Actually, this is section 48.3 only. This is section 40 capital A subsection 3. Yes. Let's move on to next. Section 59. What is this section 59? Deemed income. Deemed income is copied from section 41 subsection 1 of PGBP. I'll just have a quick recap of section 41 subsection 1. Any expenditure or any loss for which a deduction was allowed to in the previous years, past years, against that expenditure, against that loss, some sum of money is received in the current year, it will become taxable in the year in which money is received. Then we had one more point here. Any trading liability for which a deduction was allowed earlier, and in the subsequent year, there is a remission or cessation of trading liability. Then the benefit which is accrued because of remission or cessation of trading liability, that benefit will become taxable in the year in which there is a remission or cessation. Do you recollect that section 41 subsection 1? Yes or no? Yes. Now let's quickly go through certain exempt incomes. Yes, deemed income of PGBP. It was section 41 subsection 1. Now I'll quickly go through some exemptions. Receipts by the member of HUF. See, whatever income HUF has earned, who has to pay tax on that income? HUF has to pay tax on that income. So HUF has earned income from business. On that income, HUF has already paid the tax. On that income, HUF has already paid the tax. The profit after tax is apportioned between the members of HUF. Profit after tax is apportioned between the members of HUF. That profit which is received by the members is called as share of profit. That will not be taxed once again. Otherwise, that would amount to double taxation. Similar is the case with a partnership firm. Whatever profits are earned by partnership firm from the business, those profits are taxable to the partnership firm only. Those profits are taxable to the partnership firm only. Profit after tax, when they are distributed to the partners, so partner would receive share of profit. This share of profit is not taxable to the partner. It is exempt from tax in the hands of partner to avoid the double taxation. See, in the chapter of PGVP, we had learned salary, commission, bonus, remuneration, interest paid to the partner. That is deductible in the hands of the firm and taxable in the hands of partner. But share of profit is not taxable in the hands of partner because firm might have already paid tax on that amount. Point number 3 is section 10 clause 17. Any award or any reward, declared by the central government, state government or any institutions which are approved by the central government or state government, they are totally exempt from tax. For example, for the field of science, if you do some research in the field of science, if you have done some research, then in that case, Government of India has started Raman Award, C.V. Raman Award. It is in the name of scientist. So if you have done some research and you have received an award from the state government, C.V. Raman Award, that would not be taxed. National Award for Films. Government of India also gives National Award for Films. That is also not taxable. Besides that, Nobel Prize government is not giving, but yes, Nobel Prize should not be taxed. It should not be taxed. Central government, state government is not giving it, but central government, state government might approve that, saying that this award is given by the institution which is approved, so it is not taxable. Similarly, any other institute which is giving the award or reward approved by the central and state government, then if you receive any award or reward, that would not be taxed. For example, do you understand Kusti means fight. Wrestlers fight na. Wrestlers fight is called as Kusti in Hindi. In entire India, most of the wrestlers are from Haryana. Why so? Because in Haryana, the state government has announced a policy. The wrestler who wins the gold medal, he'll be rewarded with 1 crore rupees. So if you are a wrestler, you participate in some Olympics or maybe Commonwealth game, and if you win the gold medal, then Haryana government will give you 1 crore rupees. That is a reward. So whether it is an award or whether it is a reward given by the central government, state government or any institution which are approved by the central government or state government, that would be totally exempt from tax. Section 10 clause 16, scholarship received is also totally exempt from tax. Scholarship received to meet the cost of education is totally exempt from tax. Section 10 clause 11. This section 10 clause 11, I'll once again revise when we move on to the chapter deductions from gross total income when we discuss section 80C in detail. But do you know something called as Sukanya Samriddhi Deposit Scheme? Sukanya Samriddhi Deposit Scheme. Are you aware about this? Yes? Yes. Sukanya Samriddhi Scheme was started. This scheme was started by the government of India in the year 2014. When the Modi government came to power in 2014, they started this scheme. See, in India, a lot of places, more specifically Haryana, people don't prefer the girl child. Illegally, they do the abortion. If the girl child is going to, girl child will be born, then they will illegally do the abortion. So, because they consider girl child as a liability, actually, few people in the society, they are of very old mentality. They are of very old mentality. It is nearly impossible to change their mentality. So, they believe that girl child is a liability because in future, when we need to get her married, we need to pay huge amount of dowry. So government came out with an idea of this Sukanya Samriddhi scheme, wherein government says that you go on depositing some money in the name of girl child. We will give you this money back to you along with interest when the girl child attains the age of majority. That money will be either helpful for her education or for her marriage. In India, we people say that we are very intelligent, we are the oldest civilization, but still in India, people spend more money on the marriage of girl child rather than the education of girl child. It is very difficult to change this mentality. If you spend money on the education of girl child, you will not be required to spend on the marriage, because that girl only will earn huge amount of money. But what can we do? There are a lot of people with such mentality. So government has started the Sukanya Samriddhi account scheme. So this Sukanya Samriddhi account can be opened with a post office. You go on depositing certain sum of money. Every year you deposit money and you claim deduction to section 80C. And when the girl child attains the age of majority, this money will be given to you. You can spend this money for the education of girl child or for her marriage. So at the time of maturity, whatever amount is received is totally exempt in section 10 clause 11A. It is totally exempt in section 10 clause 11A. Let's move on to the last point. As of now, this is nearly not relevant, but yes, it is still in existence. Section 10 clause 19A. Section 10 clause 19A. It says annual value of any one palace. I have not written this by mistake. It is not place. It is palace. Palace. How many palace? Annual value of any one palace in the occupation of former ruler is exempt from tax. See, before 1947, India was ruled by Raja and Maharaja. There were 565, more than 500 Rajas and Maharajas having control over different parts of the country. After the independence, Sardar Vallabhbhai Patel ensured that now every part of the country will be under the control of the government. Maharaja were removed, their control was gone. India became a democratic country. So this Raja Maharaja, they used to stay in palace. And after the introduction of Income Tax Act, If you recollect the chapter of income from house property, if you are owning more than two properties for your residential purpose, then any two property at the option of the SSE would be considered as self-occupied. All other properties would be considered as deemed let out. So this section 10 clause 19A is giving some relief, giving some exemption to that former ruler. Say for example, Dikshit is a former ruler of this Tamil Nadu area. He was a Raja prior to 1947. He was having control on the entire state. So now he is having 10 different palaces. He is having 10 different palaces. If he occupies all those palaces for his own residential purpose, then any two palace annual value will be taken as nil as per section 23 subsection 2 clause A. One palace annual value will be exempt in section 10 clause 19A. And the remaining seven palaces, income will be taxable considering them to be deemed let out property. Income will be taxable considering them to be deemed let out property. See, that is the reason you go to Rajasthan. You go to Rajasthan in any 5-star hotel. That 5-star hotel, earlier it was a palace. They have converted it into a 5-star hotel. If you don't convert and you stay there only, if you are having more than 2 palaces or more than 3 palaces, that will be considered as let out property. And tax will be levied to you under that IFSP. You will have to pay the tax without earning the income only. That is the reason all those people, they have now converted those palaces into 5-star hotels and they are earning huge sum of money. So a former ruler, one annual value of one palace will be exempt. 2 palaces he can take advantage in section 23 subsection 2 clause A, considering them to be self-occupied. So if he is occupying more than 3 palaces, then the excess palace would be considered as deemed let out property. With this, I have completed the discussion of entire income from other sources chapter. So right now, it is already 11:28. 11:28. Do you want a break right now? In this chapter, we are having question number 1, 2, 3, 4, 5, 6. 6 questions. Out of 6 questions, 5 are already over. Sorry, 5 are left. 5 are left. 1 is over. That is question number 6. These 5 questions, question number 1 to 5, we'll discuss, but it is not going to take more than 1 hour 15 minutes. So we are on page number 255 of your book. Page number 255. So let us go through this question. Now listen to me carefully. This question is the most important question out of all. They have given the information in a haphazard manner. The provisions, besides that, provisions of capital gain chapter are also connected to this IFOS question. So you need to apply the provisions of capital gain chapter section 49 subsection 1. You have to apply section 49 subsection 4, etc. So keeping in mind all the provisions of capital gain and IFOS, this question will be discussed. Plus, in all these points, wherever something is taxable, under which head it is taxable, that also we need to decide. So against each and every point, we should write under which head there is a taxability and how much amount is taxable. Whether it is taxable or not, if it is taxable, under which head it is taxable, how much amount is taxable, that all things we should write somewhere on the left hand side margin. So question 1 says, Mr. Ganesh submits the following information pertaining to the year ended 31st March 21. Mr. Ganesh submits the following information pertaining to the year ended 31st March 21. Last line says you are requested to calculate the total income of Mr. Ganesh for the assessment at 21-22. So they are asking you to compute the total income. So they are not just asking you to calculate the income from other sources. No. You have to calculate the total income. Means even capital gain calculations you have to do. So let's move on to the first point. 29th December 2020. When Mr. Ganesh attained the age of 70 years, his friends in India gave a flat at Pune as gift. Each of them contributing sum of rupees 25,000 in cash. Sum of rupees 25,000 in cash. The cost of the flat purchased using the various gift was 3.75 lakhs. Now tell me, this point will have impact under which head? Capital gain or IFRS? Yes? Which head this point will have impact? IFRS, definitely IFRS. So my question to you is, this is gift in cash or this is gift in kind? This is gift in cash or this is gift in kind? Mr. Vishnu, Sarvana, please read the question carefully. What it says? When Mr. Ganesh attained the age of 70 years, his friend in India gave a flat. His friend in India gave a flat. For purchasing the flat, all the friends contributed 25,000 each. So this 25,000 each friend is not giving to Mr. Ganesh. They are using this 25,000. Each of the friends, they have contributed 25,000. With the help of those funds, they have bought the flat. And that flat is given as gift to Mr. Ganesh. So please don't consider this as gift in cash. It is not. It is gift in kind. Immobile property received as gift. If the stamp duty value of each property, you are not required to take up the aggregate amount here. If the stamp duty value of each property is more than 50,000, it will become taxable. It will become taxable. So, question number 1, point number 1, how much will become taxable? Please tell me. IFRS, how much amount will become taxable? Value is more than 50,000. So, entire amount will become taxable. 3.75 lakhs. Entire 3,75,000 will become taxable. Yes, have you understood this? 3,75,000 will become taxable. Yes or no? Please respond. Okay, let us proceed. Point number 2. Mr. Ganesh sold the above flat on 31st January 21 for 4.9 lakhs. He received this flat as gift in the month of December, and in the month of January he has sold this flat. So this flat is definitely a capital asset belonging to second category. Period of holding up to be applied is 24 months, that is 2 years. And the actual period of holding is less than 24 months. So you have to calculate what? Short-term capital gain. He has sold this flat for 4.9 lakhs The registrar's valuation for stamp duty purpose was 5 lakhs. Neither Mr. Ganesh nor the buyer has questioned the value fixed by the registrar. Tell me which section will play a role. Registrar's value means stamp duty value. Stamp duty value is more than the agreement value. But section 50 says, section 50C says, if the stamp duty value is more than 110% of the agreement value, then stamp duty value would be considered as full value of consideration. What is 110% agreement value? Yes? 4,90,000 plus 10%, 539. So do you believe that your stamp duty value is, who is giving me this amount of 4,12,500? Why you are taking 5%? Madam, Deva madam, how did you get this 5%? How did you get this 4,12,500? Have you taken 5% on 490? If yes, you are incorrect. You have to take 10% by mistake. Okay. So 4.9 lakhs into 110% will give you 539. Your stamp duty value is not exceeding 539. It is less than that. It is only 5 lakhs. So what would be considered as full value of consideration? Yes? What amount would be considered as full value of consideration? 4.9 lakhs, that is agreement value, will be considered as full value of consideration. So right here, for this we need to calculate short-term capital gain. Full value of consideration will be 4.9 lakhs. Let's move on to the next point. Point number 3. He had purchased. See, he had purchased. He has not purchased. He had purchased. They are using the word had. It is a past perfect tense. He had purchased some equity shares in Z Private Limited on 8th April 2000, long back, for 4.7 lakhs. These shares were sold privately. See, shares of private company are always sold privately only. Shares of private company are always sold privately. They are never sold publicly, because shares of private company, they are never listed on a stock exchange. So you have to always sell the shares privately only. They are sold privately on 20th August 20 for 3.5 lakhs. The unlisted shares, they are considered as capital asset. They belong to the second category. Period of holding to be applied is 24 months. Here definitely period is more than 24 months. So you have to calculate long-term gain. You get the benefit of indexation. But here, your full value of consideration is less. So you will not have a gain, but you will have a loss. So here you have to calculate long-term capital loss. How much that we will calculate? That we will calculate. So point number 1 will be taken to IFOS. Point number 2 and 3 will be taken to capital gains. Further, let's move on to point number 4. He also purchased a house from a friend for 2.5 lakhs on 21st January 21. Stamp duty value is 4 lakhs. He is purchasing the house or he is selling the house? He is purchasing. He is purchasing. Capital gain is gain on transfer. Here he is not transferring, he is purchasing. So, which point will be applicable here? Income from other sources, property, immovable property acquired for inadequate consideration. You calculate the inadequacy, left hand side, right hand side. Do you remember that? 10% of consideration or 50,000, whichever is higher is right hand side. Left hand side is the amount of inadequacy. If LHS is less than RHS, no tax. If LHS is more than RHS, then LHS is taxable. Here, can you tell me what is the inadequacy? Yes? What is the amount of inadequacy? 1.5 lakhs. 1.5 lakhs is the amount of inadequacy. This I will write on the left hand side, LHS. What is the amount of RHS? 50,000 or 10% of consideration. What is the amount of consideration? 2.5 lakhs. 10% that is how much? 25,000. 25,000 or 50,000, whichever is higher. So you have to select what? 50,000. Don't you feel your LHS, which is 1,50,000, is more than RHS, which is 50? Definitely yes. So your LHS will become taxable. Your LHS will become taxable under IFRS. So how much will become taxable under IFRS? 1.5 lakhs. 1.5 lakhs will be taxed to you under the IFRS. And please remember, whenever something is taxed to you under that IFRS, and if that asset you sell it in future, then as per section 49 subsection 4, your cost of acquisition is nothing but the fair market value. Your cost of acquisition is nothing but the fair market value. So in this case, if you sell this flat in future, your cost of acquisition as per section 49 subsection 4 will be how much? It will be 4 lakhs. 2.5 lakhs your actual consideration plus 1.5 lakh which is taxed to you under the IFRS. So your cost of acquisition for future will be 4 lakhs. Have you understood this point? Yes or no? Okay. Point number 5 says, Mr. Ganesh sold the above house on 23rd March 21 for 6 lakhs. This was purchased in January 21, sold in March 21. So definitely it is short-term gain. In case of immobile property, period of holding applicable is 24 months. Here it is less than 24 months. So you have to calculate short-term gain. What will be the amount of short-term gain? 6 lakhs. Full value of consideration minus 4 lakhs. What is 4 lakhs? Yes, what is 4 lakhs? Fair market value. That will be deducted. Sarvana, your capital gain will not be 3.5 lakhs. Your capital gain will be 2 lakhs. The amount which is taxable to under that IFRS, that will also form part of your cost only. Section 49(4) is applicable. Point number 6. He had purchased some equity shares in N Private Limited on 8th June 2020 from his friend for 3.9 lakhs. Fair market value is 5.7 lakhs. Shares of private company are acquired for inadequate consideration. Inadequacy is how much? Difference between 5.7 and 3.9. That is 1.8 lakhs. 1.8 lakhs. Inadequacy is the difference between 5.7 and 3.9. That is 1.8 lakhs. This will be taxed to you where? Under the IFRS. Under the IFRS. Property acquired for inadequate consideration. These shares were sold privately. See why they are using the word privately again and again? Because these are definitely shares of private company. They can be sold privately only. But if these shares would have been the shares of public company, you can sell it either through stock exchange or you can sell it privately. If you sell it through stock exchange, you will pay STD. In that case, capital gain will be taxable as per section 112A at the rate of only 10%. You will not get any indexation benefit also. But if you sell it privately, then your long-term capital gain, you can take the benefit of indexation, and under section 112, tax will be levied at the rate of 20%. So these are the shares of private company. They can be sold privately only. So these shares are sold privately. So there will be which gain? Short-term gain. How much short term gain, Sarvana? Sarvana, how much short term gain? How much short term gain? 6.3 lakhs minus how much? Should I do 6.3 minus 3.9? No. 6.3 minus 5.7. 0.6. Yes? Is that very, very clear? Yes or no? So let us now actually move on to the solution. You can't make the solution in the order in which the points are given in the question. So there are two heads of income here, capital gain and IFOs. You have to calculate capital gain first and then IFOs for the purpose of presentation of solution. So first of all, those points wherein we have capital gain head, that would be taken up first in the solution. So point number 1 is IFOs. Point number 2 is short term gain. So first of all, we'll take point number 2, short term gain. So I have this solution in front of you. Wherever the changes are required, I'll be doing the changes. You should calculate the amount and give me the answer. The solution which will be sent to you will be the revised one. Do you have this solution in the textbook? Answer 1, 2, 3, 4, 5, 6. Okay, everything is given there. Let us go there only. Which page it is? Page number 257. Dikshit, in case of immovable property, we use the word stamp duty value. In case of movable property, we use the word fair market value. So in case of immovable property, there is nothing called as fair market value. Stamp duty value is of relevance. Fair market value can be something else. Even if it is something else, even if it is more, we would not take into account. We would take into account only the stamp duty value. Yes, is that very clear? Okay, let's move on to the solution. So page number 257, this is done. It is solved, but slightly you have to do the calculation. Yes, can you tell me which is the point relating to short term, point relating to capital gains? It is point number 2. Yes or no? Point number 2. Point number 2, what will become taxable? 4.9 minus 4.9 minus what? 3.75. So here I have written short term gain. Akash, forget about the fourth point. First of all, you take up the second point. 4.9 lakh is full value of consideration. You go in the order. If you don't go in that particular order, there are chances that you may miss one of the point. 4.9 lakhs minus 3.75 lakhs, which is taxed under their IFOS. So section 49 subsection 4 will be applicable. 3.75 lakhs would be considered as cost acquisition. This would be deducted here. 4.9 lakhs minus 3.75 lakhs. 1.15 lakhs is short term capital gain. 1.15 lakhs is short-term capital gain. Is that very, very clear? Yes or no? Yes. Okay. Let us proceed further. Point number 2 is gone. In question, point number 2 is gone. Which is the next point? For capital gain, we have third point. Point number 3. Yes. So point number 3 is what? He has sold the shares. At what price? 3.5 lakhs. 3.5 lakhs is full value of consideration. The shares are of private company. They are unlisted. Period of holding 24 months is applicable. Net consideration, full value of consideration is 3.5 lakhs. Expense on transfer is 0. Net consideration is 3.5 lakhs. You apply the indexation on the cost. 4.7 lakhs is your cost. So 4.7 lakhs into 301. That is index number of the year of transfer. Divided by 200. 7 lakhs 7,350. So deduct that 7 lakhs 7,350. 7 lakhs 7,350. If you deduct, you will have a long-term loss. What is that long-term loss amount? 357 350. 357 350. I will carry forward to the next year. This long-term loss I can adjust only against long-term gain. That we will discuss in the chapter of set off and carry forward of losses. That we will discuss in the chapter of set off and carry forward of losses. So this will be carried forwarded because I don't have any other long-term gain. So this point is also over. With this, point number 3 is over. Which is the next point for capital gain effect? Point number 5. Point number 5. He has sold the flat for 6 lakhs. So you need to calculate short-term gain. 6 lakhs minus the cost 4 lakhs. This is as per section 49 subsection 4. So your short-term gain will be 2 lakhs. Is that very, very clear? Yes? One more point relating to capital gain, that is point number 6. What is that amount? 6.3 lakhs minus 5.7 lakhs. 6.3 lakhs minus 5.7 lakh is 60,000. This is short-term gain. Cost of acquisition is 5.7 lakh because of section 49 subsection 4. Section 49 subsection 4. Whatever is taxable to you under that IFOS will become the cost. So capital gain story is over. Here you are having short-term gain of 60,000. Here also you are having short-term gain of 2 lakhs. And here short-term gain of 1 lakh 15. Take the total. 60,000 plus 2 lakh is 2 lakh 60,000. 2 lakh 60,000 plus 1 lakh 15,000. Yes, is 3 lakh 75,000. So my total short-term capital gain is 3 lakhs 75,000. Is that very clear? Yes or no? Okay. And this long-term loss, long-term loss cannot be set off against short-term gain. Why na? That reason we will understand in the chapter of set off and carry forward of losses. This long-term loss will be carried forward to the next year. So capital gain story is over. Let's move on to IFOS. Tell me which is the point relating to IFOS in the question. Point number 1, IFOS 375. Point number 4 and point number 6. 1, 4 and 6. There are 3 points. Point number 1, 4 and 6. Because of point number 1, how much will become taxable? 3.75 lakhs. Stamp duty value of the property received as gift, received without consideration. Point number 4, property having a stamp duty value of 4 lakh is acquired for 2.5 lakhs. 1.5 lakh will become taxable. Point number 6, shares having a FMV of 5.7 lakhs are acquired for 3.9 lakhs. So what will become taxable? 1.8 lakhs will become taxable. So take the total of IFOS 375 plus 150 plus 180, 7,05,000. Yes, get me the total of income from other sources. 375 plus 7,05,000 is how much? 10,80,000. Now few of you may think that why we have not set up this capital loss, long-term capital loss against income from other sources, but that is also not allowed. That is also not allowed. That we will discuss in the chapter of set off and carry forward of losses. That we will discuss in the chapter of set off and carry forward of losses. Yes, is that very clear? Yes, so question number 1 is over. Is that very clear? Let's move on to question 2. Following gifts are received by Mrs. Sakshi. Mrs. Sakshi is carrying on the jewelry business, and following gifts are received by her during the previous year 2021. On 3rd October 20, she received a cash gift of 22,000 from cousin of her mother. Cousin of her mother. Do you believe that cousin of mother is relative? Forget about the cousin of mother. Your own cousin itself is not a relative. Don't get emotional. Your own cousin is not a relative. Cousin of mother is too far. This will become taxable, but the amount is not exceeding 50,000. And you know that cash gift, you have to take up aggregate amount. So I will keep this pending. If I come across some more point relating to cash gift, then I should take up the aggregate. And if that aggregate amount is more than 50, it should be taxed. Point number 2, she gets a cash gift of 32,000 from the elder brother of her husband's grandfather. Her husband's grandfather's elder brother is a relative. Husband's grandfather's elder brother, not a relative. If you have a doubt, go through that Rangoli, that flowchart diagram, family tree. So this also received from non-relative, value is 32,000. So point number 2, 32,000. Point number 2, 32,000. Point number 1, 22,000. So what is the aggregate? 54,000. It has exceeded 50,000. So it is taxable, yes or no? So point number 1 is taxable under IFOS, other sources. 2 is also taxable under other sources. Have you understood this? Yes or no? Are you all there or you are gone for a lunch? Let's move on to the next point. Point 3 says she has received a cash gift of 18,000 from her friend on 27 January 21. Cash gift from friend. That is also taxable because the amount has already exceeded 50,000. Amount has already exceeded 50,000. So this will also become taxable under income from other sources. So point number 1, 2, 3, all of them are taxable. Point number 4, she has received a bullion. Dikshit, bullion means gold bar, silver bar. She has received a bullion, fair market value of 75,000 on her birthday on 19th January 21. Birthday gifts are taxable or not taxable? Yes, birthday gifts, they are taxable, provided they are covered by the definition of term property. Bullion is covered by definition of term property. Value is already exceeding 50,000. So this point number 4 is also taxable. Yes, definitely separately, limit of 50,000 should be checked separately. All 4 points she is going on receiving gift. I think she is living only for one thing only, gifts. Point number 5. Mrs. Sakshi purchased from her friend who is also carrying a jewelry business. So Sakshi is also carrying jewelry business. Her friend is also carrying on jewelry business. She has purchased a jewelry at 2,50,000 on 25th January 21. Fair market value of this jewelry was 5 lakhs on that date. Mrs. Sakshi sold this jewelry in the course of her business on 23rd March 21. Yes, will this become taxable? Jewelry worth of 5 lakhs acquired for only 2.5 lakhs. Taxable but under PGBP, not under IFOS, because for her that jewelry is not a capital asset. That jewelry is a stock in trade, Deva madam. Not taxable under IFOS. PGBP. PGBP automatically it will become taxable. Point 6. Further, on 2nd March 21, Mrs. Sakshi purchased a building at 20 lakhs from her friend. The stamp duty value of the building on 2nd March 21 was 25 lakhs. Yes? Immovable property acquired for inadequate consideration. What is the extent of inadequacy? Difference of 20 lakhs and 25 lakhs is 5 lakhs. 5 lakhs is the extent of inadequacy. They have to write on the left hand side. Right hand side you write what? 50,000 or 10% of consideration, whichever is higher. What is 10% of consideration? 10% of 20 lakhs is 2 lakhs. 2 lakhs or 50,000, whichever is higher. You write 2 lakhs on the right hand side. 5 lakhs on the left hand side. What is more? LHS is more than RHS. What will become taxable? LHS will become taxable. So this will become taxable under IFOS. Compute the income of Mrs. Sakshi, chargeable under that income from other sources for the assessment 21-22. So they are just asking you to calculate income from other sources only. So that point number 5 should not be taken into account. For point number 5, you say that this is not taxable. For point number 5, at the end of the solution, you will say that this is not taxable under IFOS, this is taxable under the PGBP. Yes? Let's move on. Question number 2, point number 1. Cash gift received 22,000 from cousin of her mother. We have written a note here. What is that note? Sum of money received by Mrs. Sakshi without consideration. Sum of money received without consideration during the previous year exceeds the 50,000. Whole of the amount is chargeable to tax in section 56, subsection 2, clause 10. Is that very clear? So because of point number 1, 22,000 is taxable. Because of point number 2, 32,000 is taxable. Yes or no? Because of point number 3, 18,000 is taxable. See, all this point number 1, 2 and 3 are cash gift. The aggregate is required to be taken. It's already more than 50,000. So everything is taxable. Point number 4. Bullion received 75,000. This is also taxable under IFRS. Point number 5. 2.5 lakhs. Taxable. But under that PGBP, not here. So you can write a note here itself. Difference of 2.5 lakhs in the value of jewelry purchased from her friend is not taxable under that income from other sources, as it represents the stock in trade of Mrs. Sakshi. Since Mrs. Sakshi is carrying a jewelry business and it has been mentioned that jewelry was subsequently sold in the course of her business, such a jewelry represent the stock in trade of Mrs. Sakshi. So this 2.5 lakhs will be taxable under that PGBP. Last point, 5 lakhs will become taxable. Immobile property acquired for inadequate consideration. Question number 2 is over. What is the total? 5 lakh plus 22,000 plus 32,000 plus 18,000 plus 75,000. 647. 647. So question number 2 is gone. Question number 2 is over. 1, 2 is over. Now we are left with 3 questions. Question number 3, 4 and 5. Question number 3, 4 and 5. Let's move on to question number 3. Let's discuss this very quickly. Small question. Question number 3. Following gifts are received by Mrs. Neha, who is also carrying on jewelry business during the previous year 2021. On the occasion of her marriage, see how examiner has not applied his mind. He is saying on the occasion of marriage, and the first line he says Mrs. Neha. He should have used the word Miss Neha, na? These people are making the question without application of mind. On the occasion of her marriage, on 7th September 20, she has received 1,20,000 as gift, out of which 85,000 are from relative and balance from friend. On the occasion of marriage, even you receive a gift from your enemy, na, that is also not taxable. Forget about the friend and relative. Dixit says her second marriage. Dixit, in absence of information, we should always presume that it is the first marriage. Anyway, so on the occasion of marriage, even if your enemy gives you gift, saying that your good time in life has come to an end, now your bad time starts, so take it a gift from me, that will also be exempt from tax. Yes? So any gift received on the occasion of marriage is fully exempt from tax. No tax at all, irrespective from whom it is received. Point number 2, mobile phone worth 15,000 gifted by her friend. Instead of 15,000, let me make it as 51,000. Let me make it as 51,000. Yes. First point not taxable. What about the second one? Mobile phone worth 51,000. Forget about 15,000. Let me make it as 50. Forget about 15,000. Let me make it as 51,000. Value is more than 50. Still it is not taxable because it is a mobile phone, not covered by the definition of term property. Please remember, such kind of question will be asked in the examination. Question number 3 is gone. So you can refer the solution of question number 3. Let's move on to one more small question. That is question number 5. Decide the taxability of following transactions. Dividend from Mansi Jewelers Private Limited, 20,000. Fully taxable in the hands of SSE, whoever has earned. Dividend on preference shares of Infosys Technology Limited, that is also taxable. Dividend on preference shares, equity shares, shares of private company, public company, government company, any company, dividend is taxable. Up to last year, companies were paying the dividend distribution tax and the shareholders would get the exemption in section 10 clause 34. Now section 1150 with respect to dividend distribution tax is deleted. Now section 10 clause 34 is also deleted. So now what is happening? This dividend is getting taxed in the hands of shareholder. So point A, point B, both are taxable in the hands of shareholder. So point A is IFOS, point B is also IFOS. Point C, received an award from the government of India, issued in public interest for the best cricketer of the year, 5 lakhs. This is exempt from tax. Section 10, clause 17A. Section 10, clause 17A. This is exempt from tax in section 10, clause 17A. Interest on RBI relief bonds. Do you recollect? This is also exempt. Section 10, clause 15. Provided it is earned by individual and HUF. Now we do not know who is the SSE right now. So we can write if it is earned by individual HUF, it is exempt from tax. So question number 5 is also over. I am not referring to the solution. Let's quickly go through last question. That is question number 4. Question number 4. Mr. Hansi furnishes the following particulars of his income for the previous year 2021. Mr. Hansi is furnishing you the particulars of his income for the previous year 2021. Compute the income from other sources. They are not asking you to compute the amount of income from, they are not asking you to compute the amount of total income. They are asking you to compute the amount of income from other sources. So all those income which are not taxable under IFOS, you can write it as part of note at the end of the solution. Dividend from Microsoft Corporation, a US company. This is taxable under income from other sources. Not only the dividend from Indian company, even the dividend from foreign company is taxable. Definitely, if you are a resident, an ordinary resident person, your global income is taxable in India. Now listen to me very carefully. Now you tell me the answer for this. Point number B, interest on government securities. I am very much confident that you will say, you will give the wrong answer. Yes? This is taxable or not taxable? Taxable. Why? What about others? Taxable. Very good. Superb. See, if they write interest on notified government securities, now if they use the word notified, then only it is exempt. Then only it is exempt. Interest on government securities, now they are taxable. But interest on notified government securities are exempt. If you want to write this, you can write somewhere. Write somewhere here. Interest on notified government securities is exempt. Interest on government securities is taxable under income from other sources. Somewhere here on the right hand side you have the space. You can write there. Interest on notified government securities is exempt. Interest on notified government securities is exempt. So point number A, B are over. Point number C. Dividend from cooperative society, 1,500. This is also taxable under income from other sources. Winning from lottery, 4,200 net TDS as per the applicable rates. So what should be the amount of winning from lottery which should be made taxable to you? Should we levy tax on 4,200? No. Gross amount is taxable. I already told you that on these winnings, they would deduct TDS under section 194B and section 194BB. They deduct TDS at 30%. In this case, the tax rates and TDS rates are same. So the amount which you have received is 70%. Do the reverse calculation. 4,200 multiply by 100 divide by 70. You will get the amount of 6,000. 6,000 will become taxable to you under the income from other sources. Winning from camel race 10,000. Will you do the same thing here? 10,000 divided by 100, divided by 70 multiplied by 100? No. You have to do the reverse calculation only if they use the word net. Same thing I had taught you now, income from salary chapter. If they are using the word net basic salary, then everything whatever is deducted should be added back. If they are using the word basic salary, by default it should be considered as a gross basic salary. Similarly, this amount should be considered as a gross amount only. Yes? So point number A, B, C, D, E, everything is taxable under income from other sources only. Point number F, he has let out of his machinery at a monthly rent of 3,000. Monthly rent is 3,000. So yearly rent would be how much? 36,000. He spent 2,000 on repairs of the machinery. Don't take this 2,000 as per month. No one is going to repair the machinery every month. So this is yearly amount. Depreciation allowable on machinery as per income tax rule is 5,000. This also you can claim it as deduction. So what is the taxable amount? 36 minus 7, 29,000. Sarvana, who will deduct that 2,000 repairs? Point number G. He has let out one house property along with furniture. He has let out the house property along with furniture for a composite rent of 10,000 per month. 10,000 per month, so yearly rent would be how much? 1,20,000. You know that when you are charging a composite rent, if the letting of property and letting of asset is inseparable, then your entire composite rent can be taxed to you either under the head PGBP or under the head IFRS. So we are taxing under the head IFRS. About 10,000 should deduct TDS. Point D. Dikshit, you are correct. TDS should be deducted only if the amount is more than 10,000. But what if they have deducted? We can't tell to the examiner, no, this question is wrong. See, this question is a very old question. Earlier, 194B limit was 5,000. Earlier limit was 5,000, later it was increased to 10,000. So it is a drafting error in the question. So if you get the wrong question, then don't tell the examiner that your question is wrong. Solve as it is. So you have charged a composite rent of 10,000 per month multiplied by 12 months. 1,20,000. His expenditure on the above were as follows. See, all these expenditure by default you have to consider to be the per annum amounts only. Please don't consider this as per month. All amounts given in the question are always per annum unless and until the word per month is clearly mentioned. So repairs of the house 2,000, collection charges 3,000, municipal tax 7,000. This 7,000 should be deducted here. Sorry, 7 plus 3 plus 2, that is 12,000. Depreciation on building as well as furniture. 7 plus 3. 10,000 should be deducted. Insurance premium on building plus furniture. 3 plus 2. 5,000 should be deducted. Interest on capital borrowed for purchase of furniture and house. This 12,000 should also be deducted. Under that IFOS, you can claim deduction for any expenditure which you are incurring for earning the income. Whatever expenditure you have incurred for earning the income, entire amount can be claimed as deduction. Tell me what is the taxable amount? 1,20,000 minus 10 minus 12 minus 5 minus 12. Yes, 81,000 you should get. This is taxable under which head? IFOS. Is that very clear? Okay. Let's move on to next point. That is point number H. He stays in a rented house paying a rent of 8,000 per month. I am not reading further part of the question. Tell me what is the effect of this. Which head? Yes? Don't read further. What should be done about this 8,000 per month? Deva madam, you can't take it to IFHP. Akshaya, you can't take it to IFOS because it is not an income at all. It's an expenditure. Dikshit, where you are going to that HRA? It's an expenditure. He is staying in a rented premises, he is paying a rent. Till now, whatever points you have seen, all points are relating to other sources only. Yes, Sarvana says, sir, section 80 double G. But Sarvana, I have not taught you section 80 double G till now. Now let us read the remaining part. Since this house is too big for his family, he has sublet 1/4 portion of the house for a rent of 2,000 per month. Sorry, 2,500 per month. So this 2,500 per month is the rent received. He has subletted his portion of the house. And you know that income from subletting is taxable under IFOS. Because you are not the owner of the property. He also pays municipal tax and current repairs for the entire house. For the entire house. 10,000 and 16,000 respectively. Tell me what is the income? 2,500 per month multiplied by 12 months. 30,000. For earning this 30,000, you have incurred expenditure. What expenditure? Municipal tax. How much? Will you deduct 10,000? One-fourth. One-fourth of 10,000 you have to deduct. 2,500. 2,500. Yes. Next. Current repairs. 16,000. Here also you take 1/4. 4,000. What else? No. Sarvana, wrong answer. Wrong. Wrong answer. 30,000 minus 2,500 minus 4,000. What else we should deduct? Yes. What else you should deduct? You should also deduct the rent which you are paying now. You are also paying the rent. 8,000 rent you are paying per month for the entire house. 1/4 of the rent you should take now here. Sarvana, not the entire amount of 8,000. Only 1/4 portion you have let out. So you should take only 1/4 portion. 24,000. See, this point people tend to forget. Deduct this 24,000. What is the balance? 500. There is a loss. If you forget to deduct the rent, then we'll get a gain of 23,500. Sarvana is asking me, sir, 80 GG is right? Yes, 80 GG you can claim deduction, provided the conditions given in section 80GG are fulfilled. Provided conditions given in section 80GG are fulfilled. Now, I don't want to discuss those conditions right now. I'll discuss when I move on to the chapter of deductions. Yes. So, point number H is also other sources. Family pension received on death of wife. Family pension. Do remember, taxable under income from other sources. See, Mr. Hensey is alive. His wife died and he is receiving family pension. How much family pension? $24,000. Sarvana, in IFOs you claim deduction for rent only to the extent of 24,000. Remaining 6,000 you are having na. Rent paid is 8,000 per month. You have deducted here only 2,000 per month. Remaining you still have 6,000 per month. That you can go and claim in section 80GG. Definitely we will not give you double deduction. But that 6,000 you can claim. Yes, family pension received 24,000. You get deduction from family pension. Deduction under section 57. 1/3 of amount received or 15,000, whichever is lower. 1/3 of amount received is how much? 8,000 or 15,000, whichever is lower. 8,000. So what is taxable to you? 16,000 is taxable. Under that IFOS. Till now all points are related to IFOS only. This question is actually made to ensure that all the provisions of IFOS are revised. Salary as a member of parliament. This is also taxable under IFOS. Daily constituency allowance received as member of parliament. This is exempt in section 10 clause 17. See, daily constituency allowance is exempt, but salary is taxable. Income from agricultural land in Pakistan. Is this exempt? No, it is taxable. Where? IFOS. Income from agricultural land in India, 5,000. This is exempt in section 10 clause 1. Yes. Next is point number M. Interest on post office savings account. Post office savings account. Can you recollect something? 3,500 would be exempt from tax. So you have to deduct 3,500. Balance. Out of this 4,000, 500 will become taxable under income from other sources. Interest on corporation bank saving account, 2,000. This 2,000 is fully taxable under IFOS. If you want interest on saving account with post office, then only it is exempt. Otherwise, it is taxable. Interest on debentures of telco. These are taxable under income from other sources. Interest on national savings certificate 8th issue. This is also taxable under income from other sources. See, if they are using the word national savings, don't become patriotic. It is taxable because it doesn't fall into the list of exemption given in section 10 clause 15. So this will become taxable. Interest received and accrued on public provident fund. This is exempt in section 10 clause number 11. Received 20,000 interest on his contribution to unrecognized provident fund on retirement from his employer. This is taxable under income from other sources. Interest on his contribution to unrecognized provident fund. This is taxable under income from other sources. Point number P. Received 50,000 on maturity of LIC policy. Received 50,000 on maturity of LIC policy. This is exempt in section 10 clause 10D. This is exempt in section 10 clause 10D. Received a gift of 40,000 from a friend on 12th November 20. What is this 40,000? They have not mentioned anything. So it is cash only. 40,000 is received from friend and 1 lakh from brother of his grandfather. Brother of grandfather is not a relative. Brother of father is a relative. Brother of mother is a relative. But brother of grandfather is not a relative. So this is taxable under other sources. 1,40,000. Yes. Now one point has come to my mind right now. Let me ask you that. First of all, have you understood this? Yes. Now let me ask you one question. Listen to me very carefully and then answer. If you are receiving a gift from brother of your father, taxable or not taxable? Gift received from father's brother, not taxable. Very good. Gift received from wife's father's brother. Mr. Manoj is receiving gift from whom? From his wife's father's brother. That is brother of father-in-law. Taxable, not taxable? It is taxable. See, father's brother is a relative, but father-in-law's brother is not a relative. Mother's brother is a relative, but mother-in-law's brother is not a relative. Please don't get confused. So question number 4 we have discussed. You can refer to the solution on your own. Kindly refer this part as part of homework. I have discussed everything. Check whether the solution is made correctly or not. If you come across any mistake, kindly let me know. So with this, chapter of income from other sources is over. Income from other sources chapter is over. Now what I'll do now? Instead of starting deductions chapter, we can do one thing. We can start the miscellaneous chapter, page number 377. Very small chapter. In fact, I have made a separate chapter in these notes. That is actually not a separate chapter. We will complete this chapter today itself. Only 3 pages to discuss. Miscellaneous topics. This will complete today itself. Very small 3 pages chapter. I have created a separate chapter in the notes. Actually, you will not find a separate chapter in the ICI module. Do you recollect which is the charging section of the entire Income Tax Act? Yes? Section 4 is the charging section of entire Income Tax Act. As per section 4, what is chargeable to tax? As per section 4, what is chargeable to tax? Yes? Today we have completed 5 heads of income and I am asking you a question relating to the basic concept chapter. Total income is chargeable to tax. Very good. Whose total income is chargeable to tax? Whose total income is chargeable to tax? Not SSE. Not SSE. Deva madam. Total income of every person is chargeable to tax. They are not using the word SSE. Every person. Which year's total income is chargeable to tax? Total income earned in the previous year is chargeable to tax. When it is chargeable to tax? When that total income is chargeable to tax? It is chargeable to tax in the assessment year. It is chargeable to tax in the assessment year. So generally, total income earned in the previous year is chargeable to tax in the assessment year. Generally, total income earned in the previous year is chargeable to tax in the assessment year. But there are certain exceptions to this rule. There are certain exceptions to this rule. In other words, there are certain circumstances, there are certain situations wherein income earned in the previous year is chargeable to tax in the same year. Income tax department will not wait for the assessment year to arrive. Instead, they will try to levy the tax, do the assessment in the previous year itself. So generally income of previous year is chargeable to tax in the assessment year, but there are certain exceptional situations wherein the income of previous year is chargeable to tax in the previous year itself. Those situations we are going to discuss in this point. Cases where the income of previous year is assessed in the same year. So following are the cases. Point number 1. Non-resident shipping business. Section 172, non-resident shipping business. See, people who are into shipping business, they would earn money by freight. They would earn money by freight. Means they will uh, transfer, they will carry the goods using the ship from one place to another, from one country to another, and they would charge the freight. So say for example, there is a non-resident person, he is owning a ship and he is coming with that ship to India. From Indian port, he is taking some goods to be sent to USA. So there is a foreign ship owned by a non-resident person. That ship is carrying goods from India to USA. The person who is sending the goods from India to USA will pay the freight charges to the ship owner. That freight income is within his scope in India. He has earned freight because of India. That income is accrued in India. That income is taxable in India. But if you allow this non-resident person to go to USA without assessing his income in India, then there is no guarantee that he will come back. There is no guarantee that he will file his income tax return. There is no guarantee that he will pay the tax. So government says, a non-resident person owning a ship, when he takes goods from Indian port and he delivers at some other port, for that he has earned the freight, that is an Indian income that is taxable in India. We will not wait for the assessment here. We will levy tax in the previous year itself. We will assess his income in the previous year itself. Before he leaves the Indian port, his income will be assessed, tax will be collected, and then only we will allow the ship to leave the Indian port. Are you understanding? You can't take the chance. If you allow this non-resident person to go outside India, then it is not, you don't have a guarantee that he will pay the tax and file the income tax return. So don't allow his ship to go outside India. First collect the taxes and then give him the permission. So SSE, first of all, SSE should be non-resident. We are talking about a situation wherein the SSE is a non-resident. He owns a ship or ship is chartered by him. The ship is carrying passengers, livestock, mail or goods, and these are shipped at a port in India. In that case, his deemed income would be taken as 7.5% of carriage receivable, including the demurrage and handling charges. Do you remember in the chapter of PGBP, I had taught you section 44AD, 44ADA, 44AE. Those sections were talking about deemed income. Yes? So in the chapter of PGBP, we also have section 44B. That is actually not part of your CA intermediate syllabus. That section 44B says that if a non-resident person is earning freight from this shipping business, and if that income is within the scope of total income in India, then he can take the advantage of deemed income section, presumptive income. His income would be considered as 7.5% of the carriage amount. 7.5% amount will be considered as deemed income. No deduction for the expense, no allowance, no disallowance, no depreciation, nothing. In section 44AD, income is how much? 8% of gross receipts, 6% of gross receipts. In section 44ADA, income is 50% of gross receipts. In 44AE, for heavy goods vehicle, is 1,000 rupees per month per ton. Yes or no? Other than heavy goods vehicle, 7,500 per ton per month, part of the month. So here it is 7.5% of the carriage amount. Rate of tax on this 7.5% income would be the tax rate applicable to the foreign company. What is the tax rate applicable to the foreign company? 40%. For example, that non-resident person has earned a freight of 1 crore. Of that 1 crore, you take 7.5%, that is 7,50,000. of that 7,50,000 that is considered as a PGBP income, on that 7,50,000 you levy tax at 40%. So that would be 3 lakhs. Ask him to pay 3 lakhs before his ship is leaving India. So before the departure of ship from the Indian port, return of income is required to be filed. Full amount of taxes are required to be paid. Otherwise, we will not leave the ship. We will not allow the ship to leave. Is that very clear? Yes or no? Are you understanding? Okay. But if the income tax officer is satisfied that it will be difficult for that non-resident person to file the income tax return before leaving the Indian port, in that case, he can allow the non-resident to take away ship, provided some satisfactory arrangements are made in India to ensure that income tax return will be filed and taxes will be paid. So point G says, if officer is satisfied that it is difficult for the non-resident person to submit the return before the departure and satisfactory arrangement is made for payment of tax, then he may allow submission of return within 30 days of departure. However, non-resident may claim before the expiry of assessment year that normal assessment should be made for his income. See, it is not mandatory for that non-resident person to declare income as per section 44B. He can say that no, I don't want to go for presumptive income section. I am filing my income tax return. I will calculate income tax as per the, I will calculate income as per the normal provision. Then he has a right to do that. But while the ship is leaving Indian port, we will take the income as 7.5% of the freight. On that we will levy tax at 40%. And if he then doesn't want to go for presumptive income, let him file the income tax return and let him declare the income as per normal provisions. So point number 1 is over. Point number 2, assessment of persons leaving India. Assessment of persons leaving India with no present intention of returning back to India. Say for example, Sarvana has completed his chartered accountancy and he is going outside India on an employment contract for a period of 5 years. Means when he is going outside India, he doesn't have a present intention of coming back to India. For example, he is leaving India in the month of August. Then he might have earned some income in the month of April, May, June, July. And he is going outside India with no present intention of coming back to India. In that case, we will ask him to file his income tax return. We will ask him to pay the adequate taxes. Then only we will allow him to go outside India. I do not know whether you are aware about that or not. At all the international airports, there are also income tax officers which are sitting there. Income tax officers are sitting at the international airport. So they can catch you. They can ask you to show the income tax return. So before you leave India, and if you don't have a present intention of coming back to India, then we'll do the assessment. Otherwise, you will not pay the taxes. Once you go outside India, it will be very difficult for the Indian government to catch hold of you. Point number 3. Association or bodies formed for a short duration. Association or bodies formed for a short duration. Do you know Navaratri? Navaratri? Do you know Navaratri? In Navaratri, people play Dandiya. So in Mumbai, there are a lot of people who will organize Dandiya. They will hire a very big ground. They will make a shamiana, pandal, and on a commercial basis, they will sell the tickets for the entry fees, and they will earn huge amount of revenue. So people will buy the tickets, go there, they'll play dandiya and come back. So these associations are formed only for a 10 days period of time. Say for example, I have entered into a joint venture with you. I have contributed some money. You have also contributed some money. We have organized a dandiya program wherein people would enter these premises and they will play dandiya. We have made the arrangement of music system, etc. There is a singer also. So we will earn revenue out of this. But we are doing business only for 10 days. After 10 days, this business will close down. This is a temporary span of time. So all these associations or bodies which are formed for a very short span of time, if you wait for the assessment year, they will run away without paying the taxes. So government says, in this case, we will levy tax in the previous year itself. We will do the assessment in the previous year itself. We will not wait for the assessment year. Point number 4. Assessment of persons trying to alienate his assets with the intention to avoid the tax. See, in India, say for example, Sarvana is having a lot of black money. I came to know that Sarvana is having a lot of black money. Sarvana had a fight with me. I am his neighbor. One day he had a fight with me. So I decided to take a revenge. I tipped the income tax department that Sarvana is having huge amount of money. I also provided some evidence to the income tax department. Based on those evidence, income tax department raided his house. Income tax department raided his house. They have caught a lot of cash in his house. 10 crores cash, 5 kg of gold, all these things are recovered. Now what income tax department will do? They will do the assessment of all these things. They will ask for tax, penalty, interest, etc. If he doesn't pay the taxes, then his property will be auctioned to recover the taxes. So department may auction his property to recover the taxes. In that case, before department auctions his property, he would try to transfer his property. No? He would try to sell his property to someone, or he would try to transfer his property in the name of his spouse or any other person. Why is doing so? Because his intention is to avoid the payment of tax. His intention is to avoid the payment of tax. With the intention to avoid the payment of tax, he is alienating his assets. He is transferring, selling his assets. In that case, income tax department cannot wait till the assessment year. They will do the assessment in the previous year itself. They will do the assessment in the previous year itself. Let's move on to the last point, discontinued business. Last point is discontinued business. See, there are a lot of indications of a business which is very sick. A business organization which is not financially strong will not pay remuneration to their employees on time. There will be a lot of outstanding amounts. And there are the indications that nearly this business organization has shut down. In that case, income tax officer will not wait for the assessment year. He'll do the assessment in the previous year itself. For example, Vijay Mallya owned Kingfisher Airlines, did not pay the remuneration to their employees. Their employees went on a strike. So it is nearly certain that they will close down their business. So for this discontinued business, we will not wait for the assessment year. We will do the assessment of their income in the previous year itself. We will do the assessment in the previous year itself. But in this point number 5, it is at the discretion of the assessing officer. Means the power is given to the assessing officer. He has to decide whether he wants to do the assessment in the previous year or whether he wants to wait for the assessment year. Assessing officer may decide to do the assessment in the previous year. But all other points, it is mandatory for the assessing officer to do the assessment in the previous year itself. all other points, it is mandatory for the assessing officer to do the assessment in the previous year itself. Last point, discretion is given to him. Now let's move on to next small topic, not important from examination point of view, only I'll explain you slightly. Diversion of income by overriding title versus application of income. What is the name of the topic? Diversion of income by overriding title versus application of income. Say for example, I cleared my chartered accountancy in the first attempt. So I can guide people what to do if you want to clear the CA examination in the first attempt. And for example, Manoj gave examination for 10 times. Then he cleared the examination. So Manoj knows what not to do. I know what should be done to clear the examination in the first attempt. Manoj knows what not to do. So we both have taken effort, we both have come together and we have written a book. How to clear the chartered accountancy examination in the first attempt. We have written a book. Now this book is published. We have got it published, and the publisher is selling the book in the market. And a lot of copies are sold. We have kept one salesman. He is just standing outside the ICI premises. The moment student enters the premises, he does the registration for CA Foundation. When he comes out of the premises, he will ask him, "Oh, have you purchased this book? How to become a chartered accountant in first attempt?" No. How you will become CA? Only 200 rupees. So we have kept the salesman, he will sell the book. Our book is sold in the market. Huge amount of revenue is generated to the publisher, and now publisher will pay royalty to us. So we have received royalty. In the book, the first name, I am the first author. Manoj is the second author, co-author. Publisher has sent a check of 10 lakhs in my name. But we both took the equal effort to write the book. So 50% amount belongs to Manoj. So I have received a check of 10 lakhs in my bank account. Now I am writing check of 5 lakhs in the name of Manoj. This is called as diversion of income by overriding title. Out of 10 lakhs, 5 lakh income belonged to me, 5 lakh income belonged to Manoj. So I am transferring 5 lakh to him. What should be taxed in my hands is not 10 lakhs. Even though I have received 10 lakhs in my bank account, what should be taxed in my hands is only 5 lakhs. Remaining 5 lakhs should be taxed in the hands of Manoj, because I have diverted that income to Manoj. So diversion of income by overriding title is taxable income which is diverted to some other person because it belongs to him. He is having a title over it, that will become taxable in the hands of person to whom the income is diverted. It will not become taxable in the hands of the person who has actually received it. This is called as diversion of income by overriding title. Second point is application of income. Application of income means spending the income. Have you learned a chapter called as fund flow statement? Yes. There is a chapter called as cash flow statement and fund flow statement in accountancy. There is something called as sources of funds and application of funds. Have you heard something called as application of funds? Application of funds means applying the funds. Applying the funds means spending the funds. For example, I have taken a life insurance policy. So I am paying the life insurance premium. Whatever income I have earned, out of that I am paying life insurance premium to the life insurance company. That payment of premium to the life insurance company should not be considered as diversion of income. Payment of life insurance premium should not be considered as a diversion of income, It is an expenditure which I am incurring. It is an application of income. I am spending my income for my own benefit. That is called as application of income. Is that very, very clear? Yes or no? So I have covered this diversion of income by overriding title versus the application of income. Next is small topic, very small topic. Income from undisclosed sources. Income from undisclosed sources. For example, let me give you an example. Say for example, I am having huge sum of money, black money. I am having huge amount of black money. I want to use this black money in my own business. If I divert this black money in my own business, income tax department will catch me and they'll ask me thousands of questions and then they will levy the tax. So what I will do now? I have passed an entry in my books of accounts. I have passed an entry in my books of account. Cash account debit 2 crores to Mr. Ram's loan account 2 crores. Cash account debit 2 crores to Mr. Ram's loan account 2 crores. Means I have taken a loan from Mr. Ram 2 crores. So if you open the ledger account now, Mr. Ram's loan account, then on the credit side, it will appear as by cash account, 2 crores. Now government says, if we have a doubt on you, saying that this money actually belongs to you only, it is your own black money, which you are diverting in your own business, then we will ask you question on this. As to, you are saying that you have taken loan from Ram. So can you provide us the PAN number of Ram? Who is this Ram? Who has given you loan of 2 crores? Please provide us the PAN number of Ram. Government says, please provide us the PAN number of Ram. Also share the address of Ram. You want to identify who is this Ram who has given you 2 crores as loan. That too without any security. If I am unable to explain who is Ram, what is the PAN number of Ram, I am not giving the answers to the income tax department. Or I am giving vague answers, saying that Ram has gone to his native place, his phone is not reachable. I don't know his address, where he resides. PAN number, he doesn't have the PAN number. If I give such kind of useless answers, then department will levy tax on these 2 crores. This is called as unexplained cash credit. Unexplained cash credit means the credit side of someone's account, but cash entry is appearing. This is called as unexplained cash credit. So if I am unable to explain the credit entry, that will be taxed to me. That will be taxed to me. If I am unable to explain, either I am not explaining or I am providing the explanation, but it is unsatisfactory explanation. The explanation is unsatisfactory. Number 2, say for example, income tax department has raided the residential premises of Sarvana. Income tax department has raided residential premises of Sarvana because they had a tip that Sarvana is having a lot of black money. So early morning 6 o'clock, someone knocked the door. So Sarvana thought that a milk vendor has come to deliver the milk. The moment he opened the door, 10 income tax officer got in into his house. And the moment Sarvana realizes something, before that, they slapped him, sit at the corner of the house. Don't get up. So, now they have raided the house. They went in the bedroom of Sarvana. The moment that entire bed is taken up, inside the bed there is huge amount of cash. 2000 rupees notes. Lot of share certificate is also confiscated. So, he had invested huge sum of money in the shares. Physical shares, old shares. And now the department is asking him, from where did you get the money to invest in shares? He says, I don't remember. If you give such kind of useless answers, department will say that this is unexplained investment. You have done the investment, but for doing this investment, from where you got the money now? You are not providing any explanation, or the explanation provided by you is not satisfactory. In that case, this unexplained investment will be taxed to you under section 69. Point 3, this is self-explanatory. Unexplained money, bullion, jewelry. In Sarvana's house, income tax department has got 10 crores cash, 5 kg of gold and 2 kg of jewelry. He is unable to explain from where he got money to buy so much amount of jewelry and gold. This is called as unexplained money, bullion, jewelry. If he is unable to explain, say for example, his house is raided and 5 kg of gold is found. Departmental officer, they are asking him, this 5 kg of gold belongs to whom? From where it came in your house? He says, I do not know. Someone is kept here. If he gives such answers, department will say that this is unexplained. So department will levy tax. Unexplained money, bullion, jewelry. Investments not fully disclosed. For example, his house is raided and department has got, say, 20,000 shares of Reliance Industries. Dixit says this is dowry. Still it will be taxed. Illegal income, that is also taxable. Investments not fully disclosed. Say for example, his house is raided and department has got 20,000 shares of Reliance. He has filed his income tax return, but while filing his income tax return in the balance sheet asset side, only 10,000 shares are appearing. But he is found to be in possession of 20,000 shares. So remaining extra 10,000 shares is called as investments not fully disclosed. Point number 5. Listen to me carefully. Point number 5. Say for example, Deva madam is getting married. And his father has spent 10 crore rupees for marriage. Her father has spent 10 crore rupees. Do you know income tax department is having a right to enter any social function like marriage without your permission? Income tax department can enter any social function like a marriage without an invitation. So, one income tax officer has entered the marriage function of Deva, and now he is doing the calculation how much money her father might have spent. So he has totaled up all the expenditure for all this decoration. The decoration guy is caught. Now how much money he paid you for decoration? He says only 1 crore. Caterer is caught. How much money per plate? He says 2,000 rupees only. How many persons? Oh, 2,000 persons. So he has taken up the total. He cannot disturb anyone in that function. He cannot disturb anyone. Till the time function is going on, he cannot disturb. On the conclusion of the question, on the conclusion of the function, he can ask questions to that person. So, Deva's father has spent 10 crores on the occasion of her marriage. And now the income tax department has come to know about that. Income tax department is asking question to his father, and say for example, her father, he is unable to explain from where he got the money, from where he got so much amount of money to spend on the occasion of marriage. In that case, we say it is unexplained expenditure. It is unexplained expenditure. See, you have spent money means you might have earned somewhere in the past now. You might have earned somewhere in the past, but you have not showed in your income tax return. Therefore, we call this as unexplained expenditure. This will be taxed to you. Amount borrowed or repaid on hundi. Amount borrowed or repaid on hundi. Do you understand hundi? Yes? Hundi is a bill of exchange. Hundi is a bill of exchange. See, borrowing and repayment in cash is not allowed. You cannot do borrowing and repayment in huge amount of cash. That is not allowed. So government says, against a bill of exchange, you have raised money or you have repaid against a bill of exchange. That will be taxable to you. Where any amount is borrowed on a hundi or any amount due thereon is repaid. Otherwise, then through account pay check, you can borrow and repay through check. That is okay. If you want to, say for example, the date of maturity has arrived and you have to make the payment against the bill of exchange, you can pay by account pay check. We don't have any objection. But don't pay in cash. If you repay the bill of exchange on maturity in cash, that will be considered as your income as per section 9, as per section 69D. As per section 69D. So there are 6 points. Unexplained cash credit, unexplained investment, unexplained money bullion jewelry, investment not fully disclosed, unexplained expenditure, and amount borrowed and repaid on hundi. All this is called as income from undisclosed sources. This is called as income from undisclosed sources. Do you know when the demonetization took place? Do you remember the date of demonetization? 2016, 9th November. Not 17, it was 16. 500, 2000 rupees notes were cancelled. Evening announcement was made. That is tomorrow onwards, these are all invalid notes. See, just before 2016, few months before 2016, government had come out with income disclosure scheme. So if you are having, say, black money, you can declare that as income and you pay 45% tax. You pay 45% tax plus surcharge, etc. So that was around 50%. So if you want to declare your income under income disclosure scheme, then you can declare the income and pay 45% tax plus surcharge plus cess. Lot of people declared and lot of people did not declare. People who are having black money, few of them declared and few of them did not declare that black money. So when government came out with the demonetization scheme, everyone who did not declare in the income disclosure scheme, they were caught by surprise. Because in this demonetization, the currency will not, money lying with you will be considered as black money. First of all, you want to get the new currency. So the only way for you to get this is deposit money in your bank account. And the moment you deposit they will ask you a number of questions. What is the source of this? So there were a lot of chartered accountants who were guiding their clients saying that you do one thing. You declare, you deposit all this money in your bank account and then you declare in the income tax return. Then you declare that in your income tax return as income from undisclosed sources. At that point of time, all this income from undisclosed sources was taxable at 30% plus surcharge plus cess. The moment government came to know that such kind of planning is done by the chartered accountants, and in fact, a lot of people complained to the government saying that we have declared a huge amount of income in that income disclosure in that income disclosure scheme. We paid 45% tax plus surcharge plus cess. Now these people who are having huge amount of black money, they are depositing their own bank account and they will declare in the income tax return as income from undisclosed sources and they will pay tax only at 30%. So are we fooled to disclose so much amount of income and pay tax at 45%? So government came out with an amendment saying that we are increasing the tax rate here from 30% to 60%. And you have to pay compulsory surcharge at 25% plus cess at 4%. This was the amendment which was carried out by the government in budget 2017. So all this income from undisclosed sources are now taxable at 60% plus 25% compulsory surcharge plus 4% cess. What would be the effective tax rate in this case? 60% plus 25% of 60%. That is 15%. So that would be 75%. Plus 4% cess on 75. That would be 3%. So the effective tax rate is 78%. So taxability of income from undisclosed sources is as per section 115 BBE. Tax at 60% plus 25% compulsory surcharge plus 4% health and education cess. Against this income, no deduction for expense. See, this word is wrongly written as exemption. Cancel this exemption word. By mistake it is typed as exemption. It is expense. No deduction for expense. No deduction for expense and no basic exemption limit. Means you cannot take the advantage of basic exemption limit of 2,50,000 against this income. In case of senior citizen 3 lakh, in case of super senior citizen 5 lakh, you can't take the advantage of basic exemption limit. You can't set off your unexhausted basic exemption limit here and you can't claim deduction for expense. No set off of losses. If you have loss under any head of income, that loss cannot be set off against these incomes from undisclosed sources. So friends, we have completed this chapter number 15, miscellaneous topics. Thank you very much. Bye bye.